so much growth is priced into earnings expectations, and there's so much optimism priced into markets.
I think we're priced to perfection on a lot of areas. We're very susceptible to a fast pullback again.
There is sticker shock in prices, and you are seeing the stress in businesses.
The market really has been selling off quite a bit, with technology being the only group that's still in positive territory.
We're still in a bull market, but it's going to be slowing down from here.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started. Let's get your month started. Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance with your equity market positive by 0.1%. Beginning June, hitting the ground running. The calendar is absolutely packed. Going into payrolls on Friday, sneak peek of our survey. The estimate right now, 190K. The last major data point going into the Fed decision next week. Before we get to the Federal Reserve on Thursday, ECB in the mix. Big question about the ECB is not what they do this week. It's what they do next month and the extent of divergence we can achieve between the ECB and the Federal Reserve.
The hotter than expected inflation rates over in Europe didn't materially shift this view that it's basically locked in for June. This week, it's basically locked in for a rate cut. But to your point, it's going to be the rhetoric. How unified is the ECB committee saying, yes, we want to hike in July. We want to hike beyond that at a time where inflation is global and it's sticky.
How split is that governing council this coming Thursday? That news conference with President Lagarde one to watch. Before we get there, we need to talk about the Federal Reserve. The new consensus, we'll talk about this with Cameron Dawson of NewEdge a little bit later on this morning. The new consensus is like no cuts in 2024. Front page of Barron's this weekend. No cuts this year.
Which raises the specter of, okay, is that bullish or is that bearish? Have we priced in the greatest amount of economic momentum that can be behind those no cut scenarios? And are we looking at, if there is a cut, that is going to be negative for risk assets at a time where that signals greater weakness than expected? That was what Michael Hartnett over at Bank of America seems to signify. And frankly, that was the reaction that we got this past week. Last week, we saw weaker than expected, or at least in line, PCE numbers that didn't boost equities materially, and that was a signal.
Can NVIDIA keep doing the heavy lifting? In the pre-market, again, we're up by 3%. We were higher in the month of May by something like 30%. On one of the biggest names on the planet, up another 3% in the free market this morning.
It's NVIDIA's game, though. We talk about this all the time. They're coming out, we'll talk about this later, about some of their new technology and how they're going to have new iterations every year of their new processor, AMD trying to get in on the game. The problem is this isn't materializing into a broader kind of boom that a lot of people were expecting. And until it does, there is this feeling that we saw last week that there are winners and there are losers, that AI cannot lift all boats, and there is perhaps too much enthusiasm baked into how quickly this can be adopted.
Let's get to the scores this morning. Welcome to the program. Equity futures look a little something like this. Positive by 0.1% on the S&P 500. Yields coming in just a couple of basis points on a 10-year here, 447.68. In the FX market, just a slightly weaker euro, Lisa, going into the ECB later this week.
You pointed to it. This is actually a massive week. Last week was rather stagnant when it came to a lot of the economic data. This week, it's going to be the drumbeat to Friday. When it comes to jobs data, we get JOLTS tomorrow. We also get ADP jobs data. You can debate the importance of that on Wednesday. On Thursday, we get initial jobless claims. All that is the jobs-related aspect. But there's other data, too. And you talk about manufacturing. Today, we get ISM manufacturing, the actual, not the S&P Global read. And this should be very interesting. We'll also get services PMI on Wednesday. And, of course, it is that ECB jobs decision, ECB rate decision on Thursday that's going to signal how great this divergence can be at a time where people are upgrading their growth expectations for Europe and keeping them the same for the U.S. as maybe the divergence shrinks in a way that's sort of surprising.
I'm with you on the ISMs. The PMIs seem to be whipsawing sentiment one way to the other. I think the ISMs, both manufacturing and services this week, two data points to keep in mind and not to be overshadowed by payrolls this coming Friday. Coming up this next 60 minutes or so, we'll catch up with Marvin Lowe of State Street as stocks look to build on the gains of May. Julie Norman of UCL on President Biden's plan for Gaza. And Sonja Marten of DZ Bank with investors expecting the ECB to start the rate-cutting cycle. We begin with our top story. The S&P 500 looking to build on its best month since February. Marvin Lowe of State Street writing this. The momentum that comes off a global rate-cutting cycle remains intact. And as such, we think that risk assets will be supportive. Martin joins us now for more. Marvin, good morning, sir.
Good morning.
Why do you think we should be constructive through the remainder of this year, given some of the challenges on the horizon?
Yeah, I mean, for sure, the waters are getting a little bit cloudier. We're getting much more mixed data. that certainly keeps, if you will, discussions of the Fed wanting or needing to hike off the table. That's important. I mean, we've taken out probably the biggest risk of the market with the Fed saying, you know what, we really don't think hikes are something that we're going to need to consider. And then you put in all of the cutting that's going to start, beginning with the ECB, moving to the Bank of Canada. Whether or not it's as aggressive as the market expects, the next moves across the biggest monetary authorities are to lower yields. And that is a tailwind.
Let's start with the data stateside. 190 Friday is the estimate in our survey. If we get 190K on payrolls this coming Friday, is that good news or bad news for this equity market?
You know what? I actually think it's probably good news still. It's showing a moderation from that 250 or so that really gets the Fed super concerned. The Fed might look at that as a reason to only signal that they only need to go one more time this year. So we'll see how that parses. We do get one more CPI number. It comes the day that they make the announcement. But if it continues to show some stickiness, we might see the Fed be a bit hesitant, which would be a little bit of a bump. But it still does imply an economy that's chugging along fairly solidly.
It seems like you don't buy into some of the sea change that we're feeling in the market from other people, that essentially there has been a shift where suddenly no rate cuts is being baked in for 2024, but also there is the sense that artificial intelligence cannot save everybody, cannot increase productivity, cannot allow immaculate disinflation to continue forever. And so if you get hotter than expected data, particularly on the jobs front, that is going to equal inflation. Why do you reject that?
You know what? I don't reject it. I think the market is willing to accept that inflation and the data is moving in the right direction so that the next move is going to be a cut. I actually agree with you in the concerns that longer term inflation is probably mispriced. I don't think that we get to a pre-pandemic world from a funds perspective, from an inflation perspective, which means that we need to start thinking about divergences because other parts of the world do look like they're our star kind of in the technical sphere of where rates need to be. Gets back to where we were 2015, 2016-ish, and that creates a bit more volatility. But the market's not focused on that at the moment.
Right, and it's difficult to really go long term when we can't even predict what's going to happen next week.
Sure.
But there is this question right now of, okay, let's say that there is a rate cut suddenly baked into expectations, or let's say the Fed does cut rates. And I want to go to Michael Hartnett's point, this idea that the first rate cut will be a reason to buy bonds and sell stocks. This is completely counterintuitive to where the market was earlier this year, where everyone was saying, buy everything if the Fed cuts rates, because that's going to boost risk assets as well. Do you agree with that? That if there are rate cuts, it will be for the wrong reason, period, full stop?
I think that we'll see how the data evolves. I think the rate cut is going to really start the conversation of how deep cuts can be. I expect it to be much more shallow or much less deep, if you will, than what the market's expecting. And then it really puts a spotlight on what parts of the risk paradigm performs better in an inflation environment that isn't necessarily as sanguine as a lot of the forward pricing and expectations are around it.
Is this the right conversation to be having? The extent of the rate cuts we may or may not get over the next 12 months, or is it still whether we get one or not from the Federal Reserve?
I think it's the right conversation to have. I do think that we are going to be range bound this summer. Whether it comes from a currency perspective or whether it comes from an interest rate perspective, that's solid for risk just because there's lower volatility and kind of the inputs that go into the global macro discussion. But it also gives us the time to what's the world going to look like a year from now. That's not too far.
Most important Fed speaker of the last week or so is a guy who's not even on the Fed. He used to be. It's Bill Dudley, former New York Fed president, who was speaking in a Bloomberg opinion column in the last week or so and said this: perhaps the Fed's mantra, instead of higher for longer, should be higher indefinitely. Did you read that piece? What did you think of it?
I did, of course. It really does highlight the fact that the Fed is not going to be as effective, effective in cutting rates as aggressively as the market thinks. The neutral rate's a lot higher than what a lot of people expect.
So talk to me about leadership in the equity market at the moment. So last month, the usual suspects, Nvidia, top of the pile, throw in some utilities as well. Where's the leadership going to come from?
I think it's a continuation of that. At this point, it's a bit discouraging that we haven't seen a broadening out of the equity rally. So people are still buying their winners, and it's the easiest and path of least resistance to keep going down those routes.
Do you think the second half will be the revival of the European trade, though? I mean, we're talking about the U.S. in particular, but I do wonder about the divergence, not just in FX, especially as you do see increasing economic prospects for the Euro region, but also, frankly, just on equity valuations as well.
Yeah, you know what? The challenge for the rest of the world is that they don't have NVIDIA on their exchanges. I mean, those are very, very powerful companies. Europe itself is a bit more value oriented, and that always kind of keeps us a little bit shy from that. I think credit becomes really interesting in Europe because from a spread perspective, there's still a lot more spread compression you could see there than here. And the companies are generally, well capitalized. So, I look at Europe as providing opportunities on not necessarily just the equity world.
Given that, how important is some of the guidance going to be on Thursday from the ECB, not just from a foreign exchange standpoint, but also just an investment thesis, whether you go more aggressively into credit there?
Yeah, for sure. The view that all of these central banks are locked and loaded and they're going to start going in succession is something that probably will be tested. It's not just the ECB in terms of the market's thought around that. I personally think that a lot of the central banks want to avoid a BOJ kind of environment where they get too far ahead of the Fed. If it seems that the Fed is either not going to cut this year or it's going to be questionable even if we get something in the fourth quarter. Given how sticky inflation seems to be, I think that they might hold off a little bit, which creates a little bit more of a challenge for sure.
Marvin, this was great. It's good to see you, buddy.
Thank you.
As always, thank you. Marvin Lowe there of State Street, breaking down the week ahead, going into the Federal Reserve. About a week away. Equity futures right now on the S&P 500, positive by 0.1%. Let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Mexico has elected its first female president in its history. Claudia Sheinbaum won Sunday's election in a landslide victory, defeating the main opposition party by at least 30 percentage points. She is seen as the continuity candidate from AMLO, who saw the rise of the super peso. However, the currency is weaker versus the dollar this morning by as much as 2.2%. Her and her party's wider victory has led some analysts to worry about the lack of checks on the state's control of the economy. The Fed faces a significant risk of losing its independence to political interference if Donald Trump is elected again. That's according to the latest Bloomberg Markets Live poll survey. 14% of respondents said that they expect Trump to try and demote Fed Chair Powell. Another 44% think that he'll try to weaken Fed's independence and limit its power. On the other side of things, if Biden wins re-election, 54% said that they think he'll leave the Fed alone. Online fast fashion retailer Shein is set to file for an IPO in London as soon as this week. The offering could value the company at $64 billion, that according to a person familiar. Shein's IPO could become one of the UK's biggest ever. Bloomberg News reported in February that Shein was actively looking at London after it decided that it would be unlikely the SEC would approve an IPO for them in New York. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. I can't decide if this is a big win for London or if this is really just about China and not wanting to list here in the United States.
To me, this raises a question of how much London and Paris are going to try to capitalize on some of the concerns about the regulatory approvals of Chinese companies here in the U.S. It could be a potential win for them, but you're right. How much is this really about China's appetite?
Yeah, may well be both. More on that story a little bit later on. Up next on the program, putting a deal on the table.
Prime Minister Netanyahu's team, in fact, his foreign minister, again, just said that they welcome this announcement by the president and that they did, in fact, agree that this was their proposal.
That conversation just around the corner, live from New York City this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt. That's why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
Live from New York City, welcome to the program. Counting you down to Payrolls Friday, just around the corner. Looking forward to that. The estimate in our survey, just south of $2 100K. Still pretty punchy. Equity futures on the S&P 500 positive to kick off June, with positive by 0.15% on the S&P. Yields a little bit lower in the bond market. On a 10-year, we're down by 2 basis points. The 10-year yield, 4.4729. Under surveillance this morning, putting a deal on the table.
We have every expectation that if Hamas agrees to the proposal, as was transmitted to them, an Israeli proposal, that Israel would say yes. Prime Minister Netanyahu's team, in fact, his foreign minister, again, just said that they welcome this announcement by the president and that they did, in fact, agree that this was their proposal.
It's the latest this morning. Israel's defense minister telling Secretary of State Antony Blinken that Israel is committed to dismantling Hamas. And over the weekend, Prime Minister Benjamin Netanyahu saying, quote, a permanent ceasefire is a non-starter. Julie Norman of UCL joins us now for more. So, Julie, it begs the question, what exactly is on the table?
Yeah, well, good morning, John. This is a proposal that in some ways has already been discussed in the past, but it's out in the open now. It's a 3-phase proposal, starting with a 6-week ceasefire that would see an initial release of most hostages in exchange for many Palestinian prisoners, obviously cessation of hostilities, and also quite crucially, an influx of humanitarian aid. That would be followed by a second phase that would have some kind of agreement negotiations for a permanent ceasefire and the remaining hostages released. And I would say this is the trickiest point, getting to that permanent ceasefire. And then a third phase of reconstruction, which is still somewhat unarticulated. Again, this is the model we've been working for a while.
Julie, do you think this proposal was just for domestic consumption here in the United States, or was it to really put pressure on Israel to play out this story publicly?
You know, John, it's a great question because I think it's easy to look at this move from Biden. He's in this tough spot on this issue as well as many others. There's a tick down to the election, and to see this just as a political move. I think there might be some merit to that, but in reality, this is the administration really just having a last-ditch effort to revive these ceasefire talks that just keep stalling. You know, usually these talks are intentionally behind closed doors. You don't want the public pressure from politicians or from the public. And this time we see the administration just taking a very different tack and turning that on its head and saying, look, we're going to show the world what is on the table, let regional pressure, domestic pressure, and international pressure try and push this forward.
In the meantime, Julie, a lot of questions around Netanyahu's response at a time where some people, including the Biden administration, are saying his response was for domestic consumption and that he's facing a lot of internal pressure from the leading party that backs him in Israel. Do you buy that, or do you think that basically it is a non-starter and this is basically a way for Biden to say, we tried, wash their hands of it, and then try to move on?
I think it's a little bit of both, Lisa. We're used to Netanyahu sort of speaking out of both sides of his mouth when it comes to these discussions around the war. You know, trying on the one hand to nod to some of the Biden administration's wishes and suggestions, but at the same time dealing with the reality of the far-right elements of his cabinet that could essentially just, knock down the government. And so that has been ongoing. I would say for Netanyahu, though, finishing this war on Israel's terms in terms of depleting the capacity of Hamas has been clearly articulated by him from the beginning. I don't think he's going to give that up. And I would note also that, many Israelis are behind this. This is not just Netanyahu. We see about 80% of most Israelis supporting the war, even thinking it should be going further. So I would say he's dealing with public opinion, his cabinet, but also what he sees as increasing pressure from the United States and trying to navigate between all of these different pieces.
Julie, I'm trying to understand how much this conflict really is reshaping some of the ties that the U.S. has with other nations, particularly when it comes to other conflicts as well. We've seen certain European nations condemn Israel. We've seen a number of nations pull away from the United States. We've seen some pretty heated rhetoric in the Middle East. Have you seen any increasing true fissures between the U.S. and its allies over this that's lasting and could potentially have crossover to other conflicts?
Yeah, what I would say is that I think it's somewhat underappreciated how much of a hit the U.S.'s image has taken overseas regarding the stance on the Gaza war, really since the start of it. That's definitely true in the region, and I would say it's true across much of the global south, and it's certainly being exploited, so to speak, by the U.S.'s adversaries, Russia, China, et cetera. I would say in Europe, it's a bit more of a balancing act. As in many places, I think many civilians, many young people, et cetera, are watching this closely. But we still see many governments trying to balance between what they see as concern for Gaza and keeping up their relationships with the United States.
I ask this because there was this meeting in Singapore with a number of foreign defense leaders within a lot of global nations, including the U.S. and China. And it seemed like there was an appeal going on, basically, for moral leadership and this idea of who could offer more to some of the nations in the region to generate some sort of coalition. And I'm just wondering how much the U.S. image has been dampened, or what sort of the lines are that are being drawn, whether it's just purely economic or whether there is a sort of, leadership at another level that's coming through on these.
Yeah, I would agree. I think much of the world is saying who can actually move this forward. And I do think this ceasefire bid by Biden, so to speak, was one response to that. I will note also that part of the Biden administration's approach to all this has been very strong regional diplomacy and really getting most countries in the region on board with long-term visions of a normalization deal between Saudi and Israel, a two-state kind of plan moving forward. And that has buy-in from more countries in the region than we've ever seen before. So I would say on that governmental, more elite level, the U.S. has been doing the work, even if they're losing ground among popular opinion.
Judy, do we have a sense of how things might change if we get a change in the White House in the next 12 months?
Oh, I think they would change massively. I think we're all aware of that. On the Middle East, I think there's some who think it's just more of a difference between substance and style on Trump and Biden. They see both as being very supportive of Israel, what have you. In reality, policy-wise, they're very different also. The type of diplomatic engagement we see from the Biden administration is much more intense around the region than I think it would be under Trump, as is this push for some sort of resolution to the conflict. And I think many actors in the region are well aware of that, including Netanyahu and including Israel.
Interesting. Judy, thank you. Judy Norman there of UCL on the current situation in the Middle East and the prospect of change in the next 12 months or so. On the conviction of the last week or so, the polls are starting to come out. This from Morning Consult. We'll talk about this in detail a little bit later on this morning. Over half of voters, 54%, approve of the historic decision to convict the former president last week. Lisa, this line stood out too. The Friday survey showed that just 15%, 1/5, of Republican voters nationwide want Trump to drop his White House bid, which tells you the support on the one side of the aisle is still very strong.
Yeah, I mean, another way to sort of split the hairs here is that 96% of Democrats say that the guilty verdict was the right one. So did 56% of independents. 8 in 10 Republicans, to your point, say that it was the right, that basically it was the wrong verdict. It was a bad trial and he should move forward. The split, the fissures are not getting closer together. And this trial did nothing to really push the actual sort of believers one way or another. The question is now, to me, actually moving forward, what does this do in putting sort of the legal system in the crosshairs of the discussion and trying to sort of, cast it with one light or another? And that, I think, is potentially problematic.
Terry Haines of Pangaea is going to be joining us very shortly on the politics in the next hour, so look out for that conversation. Coming up in just a second, we'll catch up with Bloomberg's Enda Curran, with manufacturing in China gaining at its fastest pace in about 2 years. Compare and contrast that to the official manufacturing data we got last week, and we got a bit of a different picture, didn't we?
Yeah, honestly, first of all, I think manufacturing is sort of a red herring anyway, because they're juicing it, and we know that. That's part of the whole issue, is that they're juicing manufacturing to try to create cheap exports to put to the rest of the world. A lot of people saying, well, this isn't actually stimulating growth. So official numbers versus some of the other numbers, what's actually getting out there. To me, the issue is just ultimately how sustainable is this? And what happens if China isn't able to sell those cheap goods? Are these just going to be basically building houses to nowhere, bridges to nowhere, entire cities that are empty? And really, this is one of the sort of angst that people have about what China is doing and how it's going to percolate into the global economy.
Cheap EVs just piling up abroad because seemingly the walls keep going up in places like the United States. If you are just joining us, welcome to the programme. Massive week ahead for you. On Friday, we've got payrolls data. On Thursday, an ECB rate decision. And throughout the week, a sprinkle of important economic data. Equity futures on the S&P 500 positive here by 0.1%. There is a little bit of a lift in this equity market to build on the gains of May as we kick off the month of June. In the bond market, yields coming down just a touch. We're down 2 basis points. Your 10-year, 447.29 from New York. This is Bloomberg. Live from New York, welcome to the program. The scores look like this Monday morning. Good morning to you. Equity futures at the moment positive by 0.1% on the S&P. The Nasdaq up by close to 0.5. The Russell, small caps outperform on the morning at least, up by 0.9, leaving behind May, a decent May, with the S&P closing out the month up close to 5%. The Nasdaq 100 higher by more than 6%. And within the S&P, and we'll talk about utilities a little bit later, the utilities higher last month, for the best month in a year, up by 8%. We'll figure that out in a moment. Let's turn to the bond market. 2-year, 10-year, 30-year. Very first day of May trading, we kissed 5%, and then we retreated, then we pushed closer to it, then we retreated, and yields are lower this morning by a basis point and down across the curve last month by double digits on 2s and 10s. Your scores this morning, a 2-year 486.22, on a 10-year 447.09, with tons of economic data this week. Lisa's been through it already. We'll talk about it more in just a moment. It concludes on Friday with Payrolls Friday just around the corner. Want to finish on foreign exchange? If you switch to the board and get to the euro looks like this at 108.32. That currency pair negative by 0.1%. The dollar had its first monthly drop since December. Some dollar weakness last month. Let's see if we get more of that this month. The big conversation we'll have, the split between the ECB and the Federal Reserve, not over the next month, but over the next 6, 9, 12 months. Under surveillance this morning, a busy week of economic data on deck with the labour market very much in focus. The ADP report on Wednesday, followed by jobless claims and an ECB rate decision on Thursday. The main event is Friday, Bramo. Payrolls Friday, just around the corner.
What's the potential bigger surprise for markets? We've been talking about this a lot, that it's not necessarily the number itself, it's how markets respond to it. Is there sort of an asymmetry here about an upside surprise not necessarily causing as much of a reaction as a downside surprise in terms of maybe bringing back the specter of some weakness that really seems to be the new fear at a time where suddenly people are pushing back rate cuts for the right reason that can support things where they are?
The Federal Reserve has stated quite clearly that they won't be hiking interest rates. Even the most hawkish on the committee, who is saying, sure, we'll leave it on the table, which speaks to what you're talking about, is the asymmetric risk, i.e. would this market respond more to a downside surprise than it would be an upside surprise? I'm not so sure anymore, because this market has responded in ways that I would not have been able to anticipate. The move that we saw on the S&P Global PMI just a number of weeks ago. Nvidia is a great example of this. Nvidia comes out, crushes it, stock surges, and equity market does absolutely nothing. I think things are getting a lot more unpredictable in the equity market.
Peter Scheer put it well. There's a lack of liquidity. There are a lot of algo traders, but not necessarily sort of deep pools of capital that are having a lot of conviction one way or another. So it leads to a lot of jumpiness. That said, I think that the way that the move goes is instructive. We think about a downside surprise as maybe being positive in the past, because a downside surprise would mean rate cuts that could potentially support equity valuations. I don't know that that will be true this time. It feels like weakness is not going to be treated well by risk assets, because right now people are worried about some sort of rapid deceleration in growth that is not being priced in anywhere. And that, to me, I think is the bigger issue.
We'll get the guests to try and define what weakness is on Friday. Sub 190, 180, 170, 150. Fair point. We'll put them on the spot. Crude at the moment is negative by a third of 1%. Brent crude $80 and about 86 cents. WTI 76.70. OPEC Plus laying out a timetable to unwind some oil production cuts. The bloc saying some supply reductions can come to an end starting in October. However, voluntary cuts from key members, including Saudi Arabia and Russia, are expected to continue into next year. So a bit of give and a bit of take over the weekend.
So I always try to go to Halima Croft over at RBC for some insight, because I didn't really know what to make of this. Is this bullish? Is this bearish? She said, we do see today's decision as potentially providing a beneficial backdrop for the U.S.-Saudi grand bargain negotiations. That basically this opens up the door to more diplomacy between a White House that's watching the price of oil very carefully, particularly the time frame. Think about October. The desire to keep some stability here. This isn't an OPEC that wants $100 a barrel. This isn't an OPEC that's trying to jawbone prices higher. This is an OPEC that wants stability, and they also want diplomacy, and that I thought was a really interesting takeaway.
Perhaps even an OPEC that can't achieve triple-digit crude, which was the take of Javier Blas of Bloomberg Opinion overnight. More on that story a little bit later. Let's turn to this one. China's manufacturing activity growing at its fastest pace in 2 years. The data boosting sentiment out of the country on top of improving home and vehicle sales. Two of China's biggest cities also seeing a housing market pickup after government measures to lower down payments and fund purchases. Bloomberg's Enda Curran is with us down in DC for more. So Enda, help us out with this. We had one data point over the last week suggest that manufacturing wasn't as great as anticipated. Another one overnight that said it's pretty decent. Which one is it?
Yeah, so two very different takes on China's manufacturing sector. The Caixin PMI reading is a private sector gauge. It looks at smaller companies, mostly export-orientated in different parts of the country than the official gauge, than the companies that the official gauge looks at. The private sector reading, as you mentioned, looking upbeat. There are some seasonal factors behind that, Jonathan, some technical reasons. Underneath the bonnet, some suggestions that companies in the consumer sector are doing okay. But really, the bigger takeaway from the China manufacturing data over the weekend was the official reading that came out on Friday. That speaks to a broader swathe of companies. That's still in contractionary territory. That's speaking to the idea that new export orders are coming off the boil a little bit. And I think most people are saying net on net that the takeaway from the China manufacturing data over the weekend is the sector's under pressure. And of course, going forward, will remain under more pressure given the protectionist measures underway both from the US and with the EU set to take its own decisions on the EV space over the coming days and weeks.
And we're all aware of where some of the problems are. Policymakers are too, and they're trying to address a few. Number one is the property market. That headline I read out just a moment ago, that two of China's biggest cities are also seeing a housing market pickup. I understand that that's a pickup from a very low base. These problems have plagued this economy for a while now, Enda. But where are you seeing developments? Where is that policy effort really starting to bite?
It's very early stages. I mean, that pickup in prices that you mentioned, Jonathan, is obviously a welcome sign. But a lot of people are making the point that it will take months before this policy starts to see traction. The most important development over the past few weeks is that the authorities have decided now to ramp up their efforts to turn around the real estate sector. That's important. We saw that raft of measures that were announced over the month of May. Most people agreed that it's the most significant step taken by the government since the property sector went into a slump. But also it will take time for that to become clear. But that'll be worth closely watching. You know, the new vehicle sales pickup, by the way, is considered a very important indicator for China. For a lot of people, their favourite indicator is new car sales. And that tick up in auto sales that came out over the weekend could be an important gauge to keep an eye on going forward too.
And are we just looking at some of the details in a bigger picture that is continuing to defy logic to a lot of particularly U.S. economists? I'm thinking of Paul Krugman. He spoke with Bloomberg TV overnight, and he was talking about how Chinese leaders are, quote, bizarrely unwilling to use more government spending to support consumer demand. And the fact that there is a sort of effort to just increase production of goods that they can export to the rest of the world is doing nothing to really support the average consumer. Is that how you see it, or is that overly simplistic and a sort of Western shaded view that doesn't take into account certain things that maybe domestically people are touting more?
Well, look, domestically, China set a growth target of about 5% for this year. That means the authorities have to hit that. And one of the key cogs in meeting the target is the manufacturing sector. When you have the real estate sector in the slump that it is, early stages of a turnaround, when you have the consumer side of things, you know, somewhat subdued relative to where it should be, that leaves the manufacturing side, and they are trying to juice the factory side of things to generate what growth and activity they can. So remember, the political objective here is to hit that 5% target. Now, of course, along the way, that brings up problems of its own, which is they're manufacturing a lot of surplus goods that they clearly cannot sell at home, and they are putting those into the global market, and that's stoking the political demand. But where the Chinese authorities will respond and counter is that they would say, look what we're doing now in the property sector. We are putting money into that sector. We are making it easier for people to get home loans and for developments to get finished, giving cheap financial aid through the banking system there. That will stoke domestic demand, and that will get consumers buying more produce at home. So remember, the political objective for China, they have to hit the 5% target. Yes, that stokes criticism of what they're doing in the manufacturing side, but they will say they're putting money on the table and trying to revive the real estate sector too.
One thing that was apparent over the weekend from the Singapore meeting where everyone got together from the foreign ministries of a host of different governments was that both the U.S. and China were both trying to appeal, particularly to Southeast Asia, to say, get on board with us. Do you see economically China making inroads that are greater than the U.S. is, particularly in the region as they try to shore up sort of an alternative axis to what they see with U.S. pushback becoming increasingly apparent?
I think China is clearly deepening its trade linkages in the region. Take the great supply chain readjustment story that's going on at the moment, for example, Lisa. production that has shifted out of China has shifted into part of Southeast Asia, but it remains very much part of the China value chain. So when you listen to governments from that particular part of the world, they're always keen to stress they're not going to choose sides in this. They're kind of emerging, if you want to call them, as middle connector type economies. Your Vietnams, your Malaysias, they're doing business with both sides of the world. The US is obviously involved, suffering optically because of the Israel-Gaza conflict on the one hand. China, of course, steering somewhat clear of that. And they are taking advantage of the pressure on the US diplomatic look globally. They are continuing to deepen their economic linkages, not just in Southeast Asia, but in the rest of the world. And don't forget, trying to peel off Europe from the US too. Don't forget that visit by President Xi to Europe only a few weeks ago, making clear the case that China remains open for business also as an alternative to the US.
And speaking of choosing sides, the former president has joined TikTok, the platform he tried to ban several years ago. Whose side are some of the leaders actually on regarding this effort to ban or ultimately sell this platform?
I mean, it's fair to say this has become a very confusing topic as a symbol of US-China economic relation, Jonathan. Obviously, domestically speaks to its potency as a political communications tool, I suppose. But there's no doubt that, President Trump, he led the push to ban it when he was in office. Then, of course, he did that U-turn when Congress were looking at it a few months ago. If anything, it speaks to the idea that, yes, if there's a change of administration, President Trump will be even more hawkish on China trade. That's what he's vowed to do. But there will also be an element of uncertainty, an element of lacking clarity in terms of what exactly China policy will be, given, for example, the sharp U-turns that the former president has performed on TikTok as an example. So I think it speaks to the idea that, yes, US approach to China is broadly bipartisan hawkish, but there's plenty of scope for confusion and volatility within that too.
And this is one of those instances, that's for sure. Enda, thank you, sir. Enda Curran down in Washington, D.C., attempted to figure out what 25 looks like, and we have no idea. And this is a great example of that. Just how things have changed so quickly over the last several years.
So Donald Trump joined TikTok. This was something over the weekend. He wants to appeal to the younger voters. Biden already has, right? The irony here is that everyone seems to be, at least the bipartisan agreement in Washington, D.C. is TikTok needs to be, brought away from Chinese ownership or at least taken out of the U.S. So, of course, one of Donald Trump's main advisors is a backer of TikTok and a big investor in TikTok, raises this question of, okay, what's more important and how do you understand any kind of framework for next year, given some of these uncertainties?
With difficulty. I think it's going to be really, really difficult to draw broad-based conclusions about what policy will look like in the next 12 months, which makes it even harder. Look at some of these things that some people are saying. Larry Summers to The Atlantic. Here's a quote for you. There has never been a presidential platform so self-evidently inflationary as the one put forward by Trump. I have little doubt that with the Trump program, we will see a substantial acceleration in inflation. It's a pretty punchy conclusion going into November.
Well, we saw also this report out of Clock Tower saying that treasuries face a massive risk if Trump gets into power, and other people saying, well, actually, we have no clue what his policies are going to be, and actually either candidate's going to come out with some inflationary policies. There just is a complete black box, and we're all trying to arrange these sort of theories into this black box, which makes us all deeply uncomfortable.
First debate at the end of this month. Looking forward to it. Anne-Marie's off for the next several days, for the next week or so before the G7, getting some rest before this campaign really picks up. Equity futures on the S&P 500 positive by 0.1% on the S&P. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Former President Donald Trump, as you guys were just saying, joined TikTok over the weekend. It was a bid to court younger voters. He made his debut with a short clip alongside Dana White, of all people, of the UFC. So again, as you're saying, both Trump and President Biden are now actively on the app that they've publicly called to ban. Trump joined the platform fresh off of his conviction of 34 felon counts in Manhattan. Trump touted that he raised $50 million in the day following the verdict. Saudi Aramco is planning a series of events in London and the U.S. to court international investors. Aramco's $12 billion share sale on Sunday sold out in just a few hours. Key executives will now be attending roadshows in London this week with a separate event in the U.S. Foreign participation is going to be watched closely this time, considering the IPO in 2019 largely relied on local buyers after overseas investors questioned valuations. Shares of Paramount this morning, they are higher by 6.8%. We've learned that the movie producer David Ellison's latest offer for Paramount includes a sweetener. That is, non-voting shareholders would have the option to cash out a portion of their stock for about $15 a share. That's a roughly 26% premium to Friday's close, but it's only for some of the shares. It's the latest attempt by Ellison to court the non-voting shareholders who feared his bid too heavily favored Sherry Redstone and her controlling class of shares. And that's your brief. John.
Danny, thank you. That stock higher in the pre-market by close to 7%. More from Danny in about 30 minutes' time. Up next on the programme, pre-committing to a rate cut.
The ECB's already committed to cutting rates in June, and they're going to do it, even though the inflation data that we got recently doesn't really justify them to cut rates in June.
So rate cuts in June and then a big fight about July and beyond. That's all coming up this week. From New York City, this is Bloomberg. Equity futures just about positive by 0.1%. Quiet start to the week, to the month. It gets busier as this week progresses. In the bond market, yields lower by 2 or 3 basis points. On a 10-year, 4.47. In foreign exchange, the euro just had its best month of the year going back to November of last year. Euro dollar positive on the month by 1.7%. As we kick off June, just a touch weaker by 0.1%. Euro dollar 108.32. Under surveillance this morning, pre-committing to a rate cut.
The ECB's already committed to cutting rates in June, and they're going to do it, even though the inflation data that we got recently doesn't really justify them to cut rates in June. The question really becomes what comes after that.
That's the big question. So here's the latest. This is how things stand. Investors expecting the ECB to kick off the rate cutting cycle on Thursday. Despite recent upside inflation surprises, the bank is also set to release new forecasts, setting up the big debate for the next move. And July is very much in sight. Sonja Marten of DZ Bank writing this: the ECB will take extra care not to send aggressively dovish signals for the remainder of the year. Data dependent is going to be the name of the game. Sonja joins us now for more. Sonja, how big is this fight going to be? Not about this month, that's done, according to the officials we've heard from. How big is the fight going to be about July and beyond?
Well, it's definitely going to be a very lively debate. The problem, as has been mentioned on your program just now, is that the inflation data recently has been somewhat disappointing. We've seen a renewed pickup in inflation dynamics. There's been some disappointment as far as the wage data is concerned, and that has, raise the bar. The ECB will cut this week. They've committed to this. But of course, what comes after that is going to be much more difficult and very much data dependent. They are not going to rush into a next rate cut right away. I think an approach where they cut once a quarter is much more realistic, because that gives them time to look at the data, see how the inflation develops. And basically what they will need to see is that the disinflationary trend continues to pick up pace again. And that's going to take a little bit of time. So I'm thinking they're going to cut now and they're going to wait until the next quarter to do another move, and then one more before the end of the year. But the language is going to be very, very cautious on Thursday.
Your line of thinking seems to be in line with what Deutsche Bank is saying as well. This is what Deutsche Bank have got to say. We've moved the balance of risk from 4 cuts to 2 in 24. The baseline is 3. Rather than a terminal rate of 2%, we now see a landing zone for terminal of 2 to 2.5. Deutsche Bank putting the emphasis on optionality over normalisation. Sonja, it feels like we won't talk about normalisation on Thursday, but I've got to ask you, what do you think the ultimate destination is? We're having this conversation stateside about where neutral might be in this economy post-pandemic. What's that sound like in Europe at the ECB?
Well, I mean, this discussion about the neutral rate, I think, at this point has become almost entertaining, because when you think of how many times the market has been revising its opinion on where the neutral rate might be, I'm not really that interested in trying to second guess that again, because to be honest, it's a moving target at this point. What I would agree with is that definitely it is higher than we thought it was going to be for a long time. And that's, there are structural issues, there's inflation, there's a lot of debt issuance, there are reasons for why rates will remain higher for a long time. The ultimate destiny, as far as the ECB is concerned, unfortunately, doesn't just depend on the ECB, and it will depend also very much on what happens in the US with the election coming up, because whether Trump or Biden becomes president will have a massively different impact on the European economy, right? Trump being much more negative for Europe, and that would suggest that the ECB can cut more next year. If Biden wins the election, that looks a bit different. So the U.S. election has a big role to play here for the ECB as well.
Well, the U.S. election is a black box, so it's unclear exactly what the ECB can do ahead of this, other than just not provide guidance. I do wonder, though, as an FX trader, whether long euro is sort of the new hot trade, given the fact that the economic data is coming in stronger, and at least the ECB is going to launch its rate-cutting cycle in a way that the Fed seems far away from.
Well, I'm going to say this. I was never a big fan of the whole parity discussion that we had not so long ago. Equally, I'm not a big fan of a discussion about becoming overly bullish on the euro. You're perfectly right in saying that we have seen some positive news out of the Eurozone. And if you look at the indicators recently, then, you know, the numbers have been better than expected. We've seen some relief, especially in countries like Spain or Portugal, some very strong data there. So it's moving in the right direction. And that is supportive of the euro, despite the fact that the ECB will be cutting rates before the Fed. Having said that, I mean, this recovery that we're seeing in Europe is a very anemic recovery. It's not a very dynamic recovery. It's based on, you know, growth in the US and export and some consumption, but it's not a very strong recovery. So I don't think it's enough to justify a very bullish take on the euro. And I also don't think we should quite give up on the US dollar either, which is still looking very solid, despite the fact that here we have seen some disappointment in the data of late.
You did mention the election, and so let's go there, because it seems like right now you don't see a real catalyst for some sort of dramatic action one way or another based on the sort of soup of information that you just laid out. Yeah. How is the election kind of shaping your trading strategy heading into the end of the year, considering it's kind of a black box, A, who's going to win, B, what that's going to look like, and C, what their policies are going to be?
Well, basically what we're doing, which I think many houses are doing, we're sort of driving two scenarios at the same time. We have a Trump scenario, we have a Biden scenario, and you know, basically what we're telling clients is, you know, kind of go where your conviction takes you personally. We can't predict who's going to win the election, but what we can say is the Trump scenario is definitely the dollar positive scenario. That's the scenario where we can see euro dollar moving towards parity, initially. So this is a very short-term affair. You know, this is going to be dollar positive initially, because it's going to be good for US growth initially. Now, what happens in the longer run becomes much harder to predict, simply because, well, none of us really know what Trump is going to do, but we suspect that his economic policies are going to backfire and therefore become a risk as well for the dollar. But short term, it's positive. So if you're betting on Trump, then yes, you're definitely looking at short euro dollar here.
Sonja, what are the policies specifically? What are you identifying here that leads to initially that burst of growth, initially that dollar strength, but ultimately a problem further down the road?
Well, there's going to be tax cuts for both, you know, corporates and households. So that's going to be a big boost for spending. It's going to be a boost for investment. That's positive. That's going to boost sentiment. So I think that's going to deliver the initial growth spurt that we expect. But of course, on the other hand of that equation, we have the leveraging of import tariffs, etc., which is going to be used to finance these tax presence. But it's not going to be enough. So the fiscal situation in the US becomes more perilous under a Trump administration. And so that's ultimately going to be the medium or long-term problem for the US. But initially, again, it's probably going to be positive.
Just quickly, Sonja, you didn't mention the Biden playbook. What's that?
Well, pretty much more of the same, right? I mean, you look at the growth forecast for the US under Biden and a Trump scenario, then actually the growth rate for the year as a whole, 2025, is not that different. The big difference is the path. So with Trump, we have an initial boost of growth, and then it sort of dies down and it becomes much weaker. With Biden, it's more sort of a level playing field, which will make, you know, the job for the Fed a lot easier than it would be under a Trump scenario, where they might find themselves, you know, sort of handicapped by the fact that inflation is probably going to rise rapidly as a result of import tariffs.
Sonja, appreciate the update and the perspective, the opinion from Sonja Marten there of DZ Bank. Here's another one for you from Peter G of Academy. The one thing I'm reasonably sure about regarding the election is that as campaigning begins in earnest, it will not be great for treasuries. Goes on to say, neither candidate and or party seems particularly interested in doing anything about the ballooning national debt, and that will weigh on markets yet again. Irrespective, regardless of who the candidate, the winner might be come November and beyond.
We've heard this from everyone. No one is talking about reducing the deficit, neither candidate. And if you look at the Biden administration, he's talking more about spending. And if you look at the Trump administration, it's what you're going to see with ongoing tax cuts. So where are we going to deal with the deficit?
We'll be talking about this in the next hour. Look out for that. Coming up on the programme, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management, Terry Haines of Pangaea Policy, Morgan Stanley's Michael Kushma, and United Airlines CEO Scott Kirby sitting down in the Middle East with Guy Johnson. All of that in the next hour on Bloomberg Surveillance.
With the worry once again that the Fed could be raising interest rates, that's what's, in a sense, causing cracks to form underneath the confidence of investors today.
The sort of volatility of expectations is really what's confusing investors.
The most likely scenario for the Fed is that they start easing in Q4, most likely September.
For the Fed to think about moving earlier, they're going to have to see more stress in the labor market.
I think we're in a good place for the economy. I'm trying not to overthink it too much.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We live and breathe to overthink it. That's what we're here for. It's exactly what we'll do over the next week. Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance begins right now. We'll keep going back to the calendar. The calendar is absolutely stacked for the week ahead. We can start for the week ahead with just looking at jobs. We'll get the ADP, we'll get JOLTS, we'll get jobless claims, we'll get payrolls. If you want a sprinkle of data elsewhere, 2 ISM prints, manufacturing and services, a central bank decision, the ECB, the appetizer for the Federal Reserve a week away.
So to me, I think it's fascinating because we saw a shift in May. We began real strong and then it sort of faded with the first weekly loss going back to the week ended April 19th in more than a month. And it comes on this idea that maybe there is some true weakness under the hood. And that seems to be an increasing fear. So if we get a downside surprise, I want to see whether risk assets really rally in tandem with bonds or whether we start to see maybe weakening for the wrong reason, rate cuts for the wrong reason.
You've alluded to this twice now. I think the most important thing this week is not just the data, it's how the market responds to it. So let's take payrolls. The estimate for Friday, 190. Previous read, 175. Do you have a decent idea for how this market's going to respond to an upside and or downside surprise?
Well, if you take a look at Citigroup's Andrew Hollenhorst, he talks about sub 150. Suddenly you could talk about July rate cuts again. That essentially it's the labor market cracking that's going to allow the Fed to really step in and enact some of its easing or at least mid-cycle adjustment policy, whatever you want to call it. To me, I wonder, though, he sees this as potentially a negative for the economy and what this means economically. I can't imagine that stocks can rally tremendously in that. Maybe you could see small caps gain materially in just on the margins, but recent activity has not shown that being a boost, given the fact that there already have been such accelerated valuations.
If last week was boring, this week is anything but. Let's kick off with the scores. Equity futures on the S&P 500 positive by 0.2%, just a little bit of a lift. We're down by 3 basis points on a 10-year to 4.4650. In foreign exchange, the euro weaker, going into what many anticipate will be, in fact, almost everyone apart from one in our survey anticipates will be the first interest rate cut for this cycle from the ECB coming on Thursday. Euro dollar 108.39. We're negative by 0.1%. Coming up this hour, we'll catch up with Dan Greenhaus of Solus Alternative Asset Management on why the Fed is likely to cut this summer. Michael Kushma of Morgan Stanley looking ahead to Friday's payrolls report, and the CEO of United Airlines, Scott Kirby, on summer travel. We begin with our top story: equities inching higher as investors shift their attention to Friday's payrolls report. Dan Greenhaus of Solus Alternative Asset Management saying this: inflation is slowly and is likely to continue slowing, but remains too hot right now for the Fed to justify near-term cuts. But with the economy slowing and presumably further labour markets slowing, the Fed will probably again feel justified in cutting rates at some point after the summer. Dan's with us around the table. Dan, good morning to you.
Good morning, sir. How are you doing?
I'm good. Can we start on Friday? What are you expecting on Friday in the payrolls report, and how do you expect this market to respond to it?
I don't think that there are no indicators that we use to forecast payrolls that suggest any meaningful deviation in the amount of job creation, whether it's 190, 170, 210 is largely irrelevant. We're still adding a healthy number of jobs. And I think from Lisa's comment just before about weakening in the labor market, there's nothing to suggest that this number is going to come in at 80 or some meaningfully weaker number that would raise alarm bells inside the Fed or the investor community.
Lisa's broader point was how the market might respond to that. And that's been difficult. Let's take NVIDIA as an example, maybe the example. Come out with numbers, pretty decent, beat and raise. We're used to that. Stock runs up 30% or so for the month of May. And the equity market doesn't run with it towards the end of May. These are things that we would have said would have happened and didn't. What did you make of that?
Well, listen, I mean, NVIDIA is I don't know even how to describe it anymore. It's obviously an exceptionally powerful company, driving revenue, driving earnings growth, changing the narrative both for the market and the economy as a whole. So I don't know that you can make any larger comment about NVIDIA and its performance or the market and its performance. At the end of the day, I think there's just in a larger sense with respect to what's happening, there is another secular shift going on here. This is not a new story. It was desktop, it was mobile, it was cloud, it's AI. I mean, we know this story.
Apparently it's desktop again.
Listen.
With AI.
I never stopped using. We're on desktops now. So
I am right now.
I don't think it's ever gone away.
Bloomberg terminal loaded.
Yeah, I think this is just a powerful narrative that's likely to be with us for years. I don't know market-wise that you can really read anything into it because it's unlike really anything that we've seen.
Although there was a feeling that you could never price this narrative highly enough, right? And that seems to have faded, right? So maybe this is the reason why, just to build on John's point, people took a real signal from the price action because it seemed like when you looked at the numbers, it wasn't being adopted as quickly as people previously thought. That AI wasn't being monetized and wasn't spreading its tentacles of glory to all these different industries in quite the same kind of way. You don't read that into what we've seen.
Yeah, listen, I mean, obviously the rates of growth will slow at some point and the law of large numbers will kick in. But I also, to the extent that we use the 90s tech boom as an analogy, the Netscape IPO was the middle of 95. And we're still living with the repercussions, so to speak, of that today, decades later. And I'm wary of making larger narrative adjustments to this change based on 1 quarter, or 2 quarters, or 3 quarters. If this is going to be what we all think it's going to be, then we're going to be reaping the benefits, so to speak, for the next 20, 30, 40, 50 years. 1 quarter to the next is largely irrelevant to me in that sense.
I get the sense that you disagree then with Michael Hartnett, who basically is shifting his anything but bonds thesis that he had in the first half of this year to, well, if you see a little bit of a pullback in bonds, buy it. Because if the Fed cuts rate, which they probably will, bonds will look good and stocks less so, because it will come on the heels of weakness. Do you agree with that, or do you think that rate cuts are actually incredibly supportive of further gains in valuation, regardless of why?
I don't have, in my forecast, I don't have some material economic weakening. You mentioned before cutting rates for the right or the wrong reasons, to borrow a phrase from The Bachelorette. I don't have the Fed cutting rates for the quote unquote wrong reasons. Now, again, I could be wrong. Wouldn't be the first time, certainly won't be the last. But I have, as the year progresses, inflation continuing to drift down into the mid-2s. That should be, along with the type of weakness that I think everyone is expecting in the form of labor market weakening, maybe some additional consumer weakening, that should give the Fed some breath to reduce interest rates. Now, obviously, the election complicates that, and any stickiness that we see, further stickiness in inflation that we see, is going to complicate that story. But I don't have a material weakening. Now, that said, with respect to bonds versus stocks, I think there's a larger conversation here with respect to weakness in stocks. And I think that a much larger conversation should be had about the difference between the market-weighted S&P and the equal-weighted S&P. I don't think that enough credence or enough benefit is given to the Fed for slowing things down if you look at the equal-weighted index. I mean, there's this argument that the Fed's raised rates up to 500-plus basis points, and you've seen no material weakness in stocks. That's not really true.
So what I'm hearing from you is you like small caps if the Fed cuts.
No, I actually think the Russell 2000 conversation is, I don't know why we talk about the Russell 2000. This is an index of stocks that...
Okay.
But I still like, listen, coming into the year, I was asked, do you prefer the equal-weighted S&P versus the market cap-weighted S&P? And I said the equal-cap-weighted S&P, which obviously has been wrong.
What about now?
I like the broadening theme. But now, mind you, Solus is a idiosyncratic. We're a hedge fund. We're an absolute return vehicle. We're looking for most attractive risk-adjusted returns in equity, in credit, et cetera, et cetera.
Do you find them in stocks or credit?
Well, certainly stocks. I mean, in both, but there's a narrowness to the credit market right now that's undeniable. Double Bs and down in the lower rated portion of the market where we spend some time. Double Bs, single Bs are trading as tight as they have in forever. A lot of the work is being done by triple Cs. What are triple Cs? It's Lumen, it's Frontier, it's Dish, it's Altice. These are not the best companies, so to speak. But there's a lot of stuff to do there in credit. I think just on balance, we have found more to do in equity. And to that point, again, we're not an indexer. We're not trying to hug the index and beat it by 100 basis points or whatever. There are themes that are playing out. since we brought up NVIDIA, I've mentioned this a number of times, but I'll do it again because I think it's important. Yes, we need chips, but we also need to build the data centers. And someone's going to build the data center. And someone's going to cool the data center. And someone's going to build the racks for the data center. And all these themes are playing out in the market right now at exceptionally profitable ways. They just don't get nearly the attention that the Mag 6, Mag 7, Mag 8, whatever it is on any given day get because they're so large. But these other names, these are multi-billion, tens of billions, hundreds of billion-dollar companies. They just don't get the attention, and that's fine for investors that are in those themes. They're reaping those benefits without getting the public attention that might drive a blow-off top.
Let's tease this out just a little bit more. Utilities, they got some attention in the last month. Is that where you are? Is that where you're focused?
We're not doing too. We certainly have done plenty in utilities, but utilities is a good example. I mean, listen, getting back to the narrowness of the S&P, only 3 sectors are beating the S&P this year. Tech, comm services, and utilities. What's even more narrow, what's even more interesting about this is within tech and comm services, just 40% of those respective sectors are beating the S&P, and in utilities, it's just a third. So you have a steadily narrowing market, no matter how, depending on how far you want to go. Are we finding stuff to do in utilities? I mean, listen, we paid attention to the space. But again, to the point I just made about just a third beating the S&P, if that's your goal, there's a very select few of names that are doing that.
We write a lot about how much money has gone into private credit, private equity funds.
I hear it's the golden age.
I hear it's the golden age as well, which means it's also the golden age of competition to find all of these opportunities. I mean, how much is that a concern for you, given that everyone's looking for the cooling center or who's going to get the strongest floor to hold the weight of some of these chips? I mean, all of the sort of stories that people are looking for any edge at all at a time where there just seems to be a glut of cash.
Yeah, I don't think that's really any different than any time in my career or really any time in modern market history. Competition has always been there for companies. Competition has always been there for asset managers. And over time, performance wins out, so to speak. Now, mind you, we don't do a ton of private credit, so to speak. We have done idiosyncratic loans over the last 10, 15, 20 years, but I don't think it's a regular part of our investment thesis. What we're trying to do is find the best risk-adjusted return, whether that's in equity or credit or wherever it might be. And I think to the point earlier, the question earlier, there's stuff to do in equity, there's stuff to do in credit. Just on balance, I think we're finding a little bit more to do in equity right now. But again, that at any given moment, including when I walk out of here, that's likely to change.
Is it more likely to be in the U.S. than anywhere else?
Yeah, we spend a lot of time in the U.S. We have a fairly large position in an environmental waste company up in Canada. We've done a bunch of work down in Brazil where there have been some idiosyncratic issues in which we've invested. We have some work in Europe, specifically London, but Europe as well. But on balance, the portfolio is domestic. That's where our focus has been and is probably likely to stay, given some of the risk, particularly in EM, that we're not as comfortable with right now as perhaps we were in the past.
I get a mid-90s feel from you. Is that fair? Sort of don't overthink this. It's going to be all right. Couple of adjustments here and there.
I tend to take a very simplistic view of, maybe some might say naive, but a very simplistic view of the investment landscape, which is corporate profits are expanding, the economy is expanding. Obviously, valuations are an issue, but in that context, the Fed is likely to start reducing interest rates. All of that on balance is positive if you find the themes that you're able to exploit. And it's not easy. I mean, if it was easy, we'd all be nobody would be sweating every day the way that some of us do. But again, as long as the economy is expanding, we're finding opportunities. I think don't overthink it. I mean, I heard you mention before about the Treasury issuance and the coming election and its effect on fiscal spending.
Regular listener.
I quoted the 5 o'clock hour, and now I've quoted the 6 o'clock hour.
Okay.
I do my homework.
You're critiquing Bloomberg.
I don't just show up here without...
Bramo's thoroughly entertained by the fact you've got sheep on your tie.
I know. What's the meaning behind it?
I don't want to say on air.
All right, then.
Dan, thank you. We'll leave that there.
Always my pleasure.
You're welcome
guys.
back anytime.
Thank you. I don't know why this isn't a weekly thing. Come on.
Solus, alternative asset management. Maybe it should be. Write in with your own complaints. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. South Africa's ruling African National Congress has begun talks with its rival to form a government. The party had lost its parliamentary majority for the first time since Nelson Mandela led them to power at the end of apartheid in 1994. The leader of the ANC, Cyril Ramaphosa, says that the result is a sign that South African people want more cooperation between major parties. Ramaphosa's ANC got a vote share of just over 40%, down from more than 57% 5 years ago. OPEC Plus has set out a timetable for gradually unwinding some of its oil production cuts. The new agreement extends the voluntary curbs from key members like Saudi and Russia well into 2025. It also begins rolling back those supply reductions in October, earlier than some OPEC watchers had assumed. Goldman called the decision bearish, that the plan to unwind cuts would, quote, make it harder to maintain low production if the market turns out softer. And GameStop shares are surging in the pre-market nearly 90% because Roaring Kitty is back again, for real this time. The Reddit account that fueled 2021's meme stock mania posted what appeared to be an $116 million position in GameStop. Keith Gill, who's known as Roaring Kitty on Twitter, posted the screenshot in the Super Stonk subreddit, because where else would you put something like that? It's his first post to the platform in 3 years. He also tweeted an image of a reversed Uno card for whatever reason. Gill returned to Twitter in mid-May, which in itself caused a leg higher in GameStop. A bad day if you believe in efficient markets. And that's your Bloomberg Brief. John.
Danny, appreciate the update. More from Danny in about 30 minutes' time. Up next on the program, Trump staying strong after his conviction.
The judge could decide to say, hey, house arrest or even jail.
It could.
Face what that could.
I'm okay with it. So that could happen. I don't know that the public would stand it. I'm not sure the public would stand for it. At a certain point, there's a breaking point.
There's a breaking point. We'll talk about that breaking point next on the program. Live from New York City this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
We are seeing the labor market come into better balance.
That foundation for the economy is solid.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is not a labor market that's slowing down or grinding to a halt, which is why everyone is looking at wages.
Payrolls report, 8:30 Eastern Time.
The May Jobs Report, Friday on Bloomberg.
The payrolls report, 8:30 Eastern Time on Friday, a few days away. Before we get there, equity futures look like this on the S&P. Positive by 0.2%, yields lower by 3 basis points on a 10-year, 446.50. Under surveillance this morning, Trump staying strong after his conviction.
The judge could decide to say, hey, house arrest or even jail.
It could.
Face what that could.
I'm okay with it. I saw one of my lawyers the other day on television saying, oh, no, you don't want to do that to the president. I said, you don't beg for anything. You just, the way it is. So that could happen. I don't know that the public would stand it. I'm not sure the public would stand for it. At a certain point, there's a breaking point.
It's the latest this morning. A new Morning Consult poll finding that more than half of voters approve of former President Trump's conviction, but a large majority of Republicans still want him to run. Just 15% of GOP voters wanting the former president to drop out. For more, Terry Haines of Pangaea joins us now. Terry, what are you learning from the post-conviction polls of the last several days?
I'm not learning very much yet, John, because I think they still have a lot of time to play out. These are essentially weekend flash polls. And I think that whatever the effect is on Trump, it's going to take days and weeks to play out, frankly. Meanwhile, Trump has the same situation in that he's had before, which is he's got a split Republican Party with anywhere from 20 to 40% of Republicans not preferring him, and he's also underwater with independents. If he doesn't right that both of those ships, I think he likely loses in November.
Terry, how do you think the sitting president will navigate this issue in the big debate at the end of this month? Is this something he tries to campaign on?
Well, I think what he does is really two things. One is, and there's some tension here in both of them. One is he personally tries to stay above the fray, and the other one is that he and the campaign repeat convicted felon over and over as much as possible. I think what ends up happening is, though, that Biden needs two things for the next 5 months. He needs to put the cognitive issues fairly well at rest, and the other thing he needs to do is look like the steadier alternative. I think those are the frames of the campaign. A lot of political people will say, well, issue X or issue Y will be the make or break. really what it's going to be is, to the extent it's a referendum on Biden, it's a referendum about whether he continues to be up for the job, likelier than not that people conclude that. And secondly, that he's the steadier alternative to Trump, and that independents, particularly and some Republicans, don't want to return to the old days.
Terry, I want to go back to something that you said, where you said Trump has split the Republican Party. Is that still true, given some of the consolidation that we've seen around Trump by Republicans over the past couple of days, even with the conviction basically coming out with the party line that it was a flawed prosecutorial discretion in terms of trying the case, where it was tried, that it wasn't a venue change, et cetera, et cetera. Do you view this as truly splitting the party?
I don't view the Trump conviction as splitting the party. I view the party as split since about mid-January, when the first primaries happened. The reason I look at it that way is because I'm not relying on the polls for this. I'm looking for how people actually voted, and what you've got is a Republican Party that by all indications doesn't completely want Trump. And the thing is, Trump has demonstrated that he knows this in the past several days, several weeks. The reason why I say that is because, he's gradually pulling out every stop he can to try to court Haley into the tent. And Haley's the protest candidate, essentially. And, Haley said that, she'll vote for him, which is not really, working for him or anything serious, but that he needs to address the needs and concerns of those many, many people that voted for him. There's a dance going on right now, may be successful, may not be, to try to get Haley into the tent and actually unify the party. But it's not there yet, but it's real.
Terry, I also wonder your take on him joining TikTok over the weekend. This idea that Donald Trump has sort of wavered just a touch in terms of whether he would ban it or not, what the sort of messaging is. How important is that type of thing to the support that he's going to get or not among the electorate? Or is that window dressing at a time where there are much more fiery talking points on both sides?
Well, the policy of both Biden and Trump on TikTok is as far as an election goes, is nothing more than convenience. You can hear the political people whispering in everybody's ear saying, look, we have to use every weapon we possibly can to get to the maximum number of voters. We've got to use TikTok. There's no alternative. So they both go ahead and do that. And they will both go ahead, just as they do with campaign finance, for that matter. They will use every tool available until it's not available anymore. And then they'll go try to use something else. So, the consistency is the hobgoblin of little minds, like Emerson said. But, when you're in hand-to-hand combat for the next 5 months, expediency is going to rule overall.
Terry, I'd love your thoughts on policy. Let's continue that conversation. Larry Summers to The Atlantic saying this: there has never been a presidential platform so self-evidently inflationary as the one put forward by Trump. I have little doubt that with the Trump program, we will see a substantial acceleration in inflation. Peter Chi of Academy pointing out there's not much daylight between the two candidates when it comes to this issue. How much daylight is there currently?
You know what? If I vote between Summers and Cheer, I'll take Cheer on this one. The fact of the matter is that it's a campaign season. Campaign seasons want to overemphasize differences. That's part of what the campaign and the argument is all about. But in reality, what you've got is a situation, for good or ill, where there's not going to be any fiscal discipline in the United States, regardless of who the president is. There is a situation where foreign policy will largely be united, just as it is now, very bipartisan. Issues on the margin. And what you're going to see is a move towards shoring up, improving, and pumping up the defense industrial base. And that is I think that's a very big deal, and frankly unifying. I think Trump will do it. Trump will want to do it at somewhat of a faster pace than Biden, who's trying to get the Goldilocks move, the just right move here, without alarming people. But that's going to happen. And so there's not a lot left, really. Markets get excited about regulation, but based on 2017 particularly, that's a triumph of animal spirits over reality. No business is going to get deregulated.
I'll let Pete know that he gets your vote. Terry, thank you, sir. Terry Haines of Pangaea. Equities right now positive 0.1%. Coming up, Michael Kushma of Morgan Stanley looking ahead to payrolls on Friday, and a little bit later, Mr. Kirby out of United Airlines with Guy Johnson. That's about 15 minutes away. Two hours away from the opening bell, equity futures look a little something like this. We're positive across the board to kick off the month of June. We're up by 0.1% on the S&P, on the Nasdaq up by 0.4. There is your outperformance. It's a new month, so we talk about the same old conversation. Can we get that big rotation to the Russell? Small caps, the Russell up by 1.2%. Lisa was talking about the prospect of weakness for payrolls on Friday. I said, what is weak? Stuart Kaiser was listening over at Citi. He says payrolls may be a banana peel. The mix could be equity positive in our view, but headline payrolls below 150 would be worrisome. Citi's looking for 140 on Friday. The median estimate is 190. So there's your answer, Bramo. Sub 150, according to Stuart Kaiser, would be worrisome.
And I would guess that Andrew Hollenhorst, over on the interest rate section of his bank, would agree with him, basically talking about how this would indicate rate cuts for the wrong reason, and everyone can roll their eyes. This is sort of good news is bad news, and bad news is good news, kind of cuteness. But basically, what you would get is real weakness in the economy not being supportive of risk valuations that have gotten pretty elevated. And that's, I think, the interesting sort of twist that we've seen also from Bank of America recently.
That takes us to the bond market, so let's set that up. Check out the scores, 2-year, 10-year, 30-year in fixed income. Treasury shaping up as follows. We're down 2 basis points on a 2-year on the session. Over the last month, down double digits across the curve. The 2-year out to the 10-year. We're down another 4 this morning on a 10-year maturity to 4.4591. Given that retreat, this is what foreign exchange looks like this morning. The euro just had its best month of the year. Positive by 1.7%, getting close to 109 at 108.41. We're negative on the session by about 0.06%. But the ECB on Thursday is the main event, and it's not about what they do on Thursday. They're going to cut interest rates in the minds of pretty much everyone on the planet who follows the ECB, with the exception of this one person who I'd love to speak to.
I know, exactly.
Who doesn't think they're going to cut interest rates on Thursday. We'll park that just for a moment. What happens in July? What does the data look like? And the limits of divergence is something we can talk about with Mohamed Al-Arian a little bit later this week when we catch up with him on Wednesday.
I agree with you. This might be the most interesting part of the whole week, especially given the fact that we've gotten hotter than expected inflation data out of Europe, and we've gotten stronger than expected growth. We had Deutsche Bank, you mentioned them earlier. They actually upped their expectation for growth in the second half in Europe by 0.5% while keeping the U.S. the same. So is that positive? Does the ECB try to keep that going with more rate cuts, or do the hawks kind of win out and say inflation isn't that quick to really kill off?
If you want to find agreement on the Governing Council right now, and this is sort of what Deutsche Bank's alluding to, you'll find it around things like optionality. Keep your options open. Sure, we don't want to shut out July completely, but maybe we don't go in July. You don't want to start talking about kicking off the process of normalisation at all. And if you go on some of the communication we've had from, say, Philip Lane, the chief economist on the Governing Council at the ECB, the Executive Board, he's talking about needing to remain restrictive through this year. And within that, you can reduce interest rates, but still needing to remain restrictive. It's the areas where you can find big agreement on the Governing Council that will really start to dance in the news conference on Thursday.
You don't want to talk about normalization because what's normal?
Exactly.
And all of a sudden, if you have to start talking about what the neutral rate is, that's a dangerous place that clearly nobody wants to talk about in any kind of collective way.
What's normal for this stock? Just sort of up and to the right. Let's get to NVIDIA. Under surveillance this morning, the CEO, Jensen Huang, saying the rise of generative AI is a new industrial revolution. Speaking in Taiwan, he said he expects NVIDIA to play a major role as AI shifts to personal computers once again. Huang also saying the company plans to upgrade its AI accelerators every year. That stock is up by another 3% this morning.
Because why not, right? I mean, we start talking about 3%. What is that, an extra, how many, $50 billion? I mean, just the scale of this is just overwhelming. But to me, when I look at this, it raises this question that we asked before. At what point do people not want to buy currently because the future iterations are going to be stronger, more powerful, more efficient? And the answer has been there is such a shortage of chips, and people want to get a head start in this AI race that it hasn't mattered. So any advancement is just a benefit. I really am actually curious about how much AMD can follow on, because they came out talking about also some improved technology that they're unleashing. Can they catch up? And that's actually a more potentially surprising question.
Do you think we've had the melt up yet for this stock? Because I often wonder, sitting here in this seat, are we having the right conversation? The right conversation to have at the end of last year was actually whether this stock could double again. That was the right question to ask. Could we do this again? Could we rally another 100% here? And I didn't hear that nearly enough at the end of last year, the start of this year. I'm just wondering with this name now, what is the right conversation?
So we should be talking about this being a $5 trillion stock by next year?
I've got no idea.
It's a good question. Basically, what is the limit to its ascent, given that it seems to be limitless at this point, up nearly 100% again this year, actually 121%. And we're talking about how they own the market. At what point is there some pushback? And this is what I think will come, is from the big tech giants in terms of their profitability. Start to push back at just how much money they are funneling to NVIDIA's profit coffers in order to get some sort of prowess. At what point do they start really investing more materially in their own chip production? I don't otherwise see a limit to this.
How long is the runway? That stock is up by 2.9% in the pre-market. Just quickly on Paramount, shares rising in the pre-market following reports that David Ellison is sweetening his offer to buy the company. Ellison is said to be including an option for non-voting shareholders to cash out a portion of their stock for about $15, according to people familiar with the matter. The Paramount chair, Sherry Redstone, is also weighing an option of taking the offer from Apollo Global Management, that combination together with Sony.
This has been sort of the ongoing consolidation that hasn't happened nearly as quickly as people previously expected. To me, it sort of seems like it's shaking out that people with very wealthy people in their lives are the ones that are taking over media, and we're seeing that pretty consistently.
Are you calling this Nepo acquisitions? Is that what you're trying to say? I'm just telling you what I'm hearing.
Well,
is that what you're saying?
I'm just saying that there seems to be that theme going through this because, otherwise, why are people going through with the acquisitions?
No interview for you if this one closes. Let's get to this. Not for me either, let's be fair. Busy week of job data. JOLTS due tomorrow, ADP on Wednesday, claims on Thursday, and the main event on Friday, the US payrolls report. Investors will be looking for clues about what it could mean for the Fed's path forward. Morgan Stanley's Michael Kushma with this to say. The Fed will cut once or not at all this year, given the current economic situation. Rate cuts only come if unemployment growth dynamics deteriorate. Inflation could easily be too high, given solid economic performance to cut rates. Michael's with us now for more. Michael, good morning.
Good morning.
Can we just sort of pair this with Friday, what you would expect to see in a few days' time?
Well, it seems that job growth is decelerating, as it probably should. The economy can't keep generating hundreds of thousands of jobs every month and maintain a reasonable economic growth, and growth does seem to be decelerating. Quit rates are slowing, and unemployment growth seems to be decelerating to a more normal level, somewhere between 100 and 200,000 per month. Don't know exactly where it is. This whole immigration issue makes it unclear exactly how much fundamental underlying demand is versus the labor supply issue. So labor supply could be growing quite rapidly, and labor demand could be slowing at the margin. So the big question will be the dynamics of, suppose the unemployment rate goes up, but job growth stays strong because of labor supply. That's sort of a perfect scenario. We can have deceleration wage growth, economy stays reasonably firm, and the Fed has this clear runway to do what it wants down the road.
And you think what it wants is basically nothing in the near term?
Everything's sort of perfect right now. Inflation is falling a little bit year on year. It's falling. There's a lot of noise in the month-on-month or 6-month averages and things like that. But it is falling year on year. And as long as that continues and the unemployment rate stays below 4%, I think the Fed sits tight. Why mess with something that seems to be going just fine? But leaving the option on the table, we will, however, cut rates if there's any sign that things will get worse. And I do think there is a dovish undertones despite what the recent commentary has been. It seems to be more hawkish. But on the other hand, it does seem that they will pull the trigger as soon as possible.
Well, so in this scenario, you see 10-year treasuries yield stuck around 4.25%. But with an upside risk to 5%, what does that upside risk look like?
The upside risk is inflation gets stickier, and it seems to be a little stickier than in the past. And we see the unemployment rate drift up, and the Fed cuts rates because it does have a dovish desire to support the economy and avoid recession. So in a combination of inflation staying sticky and growth being okay, but unemployment rising at the margin, the Fed becomes more dovish, and you get a steepening of the yield curve with back-end yields rising with sort of inflation risk. The other issue is debt dynamics. The Treasury issuing increasingly larger amounts of coupon bonds on their quarterly auctions. It's between, I think it was $500 billion this last quarter or current quarter. It can be $400 billion plus the next quarter. Global growth is improving as well. So it's not just the U.S. decelerating a bit from very, very strong levels last year. The rest of the world's doing better. We talk about the ECB. From an ECB perspective, things are looking on the up and up for Europe right now. And again, inflation is proving a bit stickier. They're having their scenario now, what the U.S. experienced like earlier in the year with inflation being a bit sticky. How much can they cut rates?
So there's a lot to unpack there, including auctions and the deficit and all of that, which we heard about from Steve Eisman. But before we get there, I want to talk about the reaction function in this market to data that we get this week. The idea that if we get a weaker than expected number, what bonds do. You're saying that if...
I think they'll rally. The bond market's desperate for good news, wants a reason to rally, it seems.
Okay, but what is good news, right? I mean, in other words, if you get, for example, a weaker than expected employment report, and that pushes forward the idea of closer or nearer term rate cuts, how does that cohere with your idea of a 10-year yield going to 5% on near-term rate cuts leading to stickier inflation?
It won't in the short term. We'll have to see as inflation materializes over the next couple of months whether or not that inflation number comes down at the same time as employment deteriorating. If you do get both, inflation's falling and the unemployment rate's going up, then you see 10-year bonds will be back at 4%.
This is all scenario analysis. Your baseline is basically Fed doesn't do much, right? We stay range bound on 10-year treasuries. So what's the argument to go out the curve? Don't I just sit at the front end and just sort of sleep well at night?
There isn't. You're getting this is the longest inversion of yield curve we've seen, I think, in post-war history. So what's the incentive to move out the yield curve from cash or other short duration instruments? There's not a whole lot to do that in absence of a significant deterioration in the economic outlook or a significant improvement in inflation, which would allow the Fed to bring rates down materially, not just 50, 100 basis points. We're talking about a normalization of the yield curve. Unless we're going to recession, we're not going to see 10-year treasuries below 375, which means cash rates have to get below 4. And that's 150 basis points away from current levels. Now we're talking the end of next year at some point, barring any real sudden deterioration. So we haven't seen a reason to extend duration. We're much more willing to take on credit risk in this environment, take on more credits than normal despite credit spreads being on the tighter side. But what's the downside? You've got a Fed willing to cut rates at the first signs of economic trouble, barring any weird inflation data. And you've got the rest of the world doing better. Yields are attractive, whether or not you think about the spreads or the absolute yield, but the U.S. high yield index yields over 7.5%. That seems to be a pretty attractive rate of return compared to a lot of other alternatives in the world.
Things could change, but I think you just explained the current dynamics in fixed income absolutely perfectly. Michael, thank you, sir. Michael Kushma of Morgan Stanley. Let's get you an update on stories elsewhere just briefly with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Waste Management, North America's largest waste recycling firm, has agreed to buy medical waste disposable company Stericycle. It's for about $7.2 billion. It's one of the biggest acquisitions in the waste management sector, and it strengthens Waste Management's position as the largest trash hauler in the U.S. The Houston-based company has bought several other disposable firms over the past few years. Saudi Aramco is planning a series of events in London and U.S. to court international investors. Aramco's $12 billion share sale on Sunday sold out in just a few hours. Now key executives will be attending roadshows in London this week with a separate event in the U.S. Foreign participation will be watched closely, considering their IPO in 2019 largely relied on local buyers. Overseas investors had questioned valuation expectations. And the Fed faces a significant risk of losing its independence to political interference if Donald Trump is elected again. That's according to the latest Bloomberg Markets Live poll survey. 14% of those surveyed said that they expect Trump to try and demote Fed Chair Powell. 44% said that he'll try to weaken Fed independence and limit its power. Now, if Biden wins re-election, 54% of those surveyed think that he will leave the Fed alone. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate the update. Up next on the program, high demand for summer air travel.
Consumer demand and that priority to invest in experiences continues to be really, really healthy. Yet the amount of capacity that we're all able to fly is significantly constrained.
Up next on the program, the view of Scott Kirby of United Airlines sitting down with a good friend of ours, Guy Johnson. That's just around the corner. Live from New York City, under surveillance this morning, high demand for summer air travel.
Consumer demand and that priority to invest in experiences continues to be really, really healthy. Our industry's capacity is lower than it's been given the constraints around OEMs, whether it's Boeing or engine issues. So our economy is a lot larger than we were historically, go back pre-pandemic, yet the amount of capacity that we're all able to fly is significantly constrained.
Here's the latest this morning. The global airline sector poised for a strong summer travel season. IATA are expecting high demand to fuel over $30 billion in net income. That's up more than 10% from a year ago. To continue the conversation, good friend of ours, Guy Johnson, sitting down with the United Airlines CEO, Scott Kirby, in Dubai. Hey, Guy.
John, thank you very much indeed. If you look at the IATA data, what it'll tell you is that a lot of the profitability in this sector is coming from the United States. And within the United States, it's coming from the big carriers. As you say, we're joined by one of those now, the CEO of United, Scott Kirby. Nice to see you, sir.
Thanks for having me.
We saw a little hiccup a few days back. American comes out, it changes its guidance, the industry reacts, share prices go down. You're very quick to come out and reconfirm your guidance on the back of that. But are you seeing any indication that the consumer is softening at the moment?
You know, it's demand for us is steady as she goes. In a way, kind of boring. After the last couple of years, I think boring is good, but it's not getting a lot stronger, but not getting weaker. It really is pretty steady.
And what changes that? Does anything change that? Does the fact that the labor market maybe started to show a few little cracks, the fact that maybe rates stay higher for longer, do any of these factors impact that strong consumer that we're seeing in the US?
It could, but we spent the last 2 years talking about the risk of recession, and the consumer just keeps plowing ahead and keeps going. And so I think that's likely going to continue. The bigger thing, the more likely change for aviation, I think, is on the supply side. We're at a peak where the number of seats is growing a whole lot faster than the demand in the United States. But as we move into the third and fourth quarter, those numbers are scheduled to come back down a lot. So I think the supply balance will counteract, even if there was some demand weakness.
Where are those seats coming through? Is it with you guys at the upper end, the full service carriers? I'm assuming
it's really across the board.
Right.
Southwest is probably the biggest grower of seats, but it really is across the board. We're growing, others are growing, kind of across the board. Just the peak. This is a lot of still recovery from COVID, and this was the time that people were getting all their ability to grow back in place. So second quarter's peak.
I can see that capacity in some ways making sense at your end of the market. Does it make sense at the bottom end of the market? Do you think all of those low-cost carriers survive?
No, it doesn't make sense. And we do the route P&Ls really accurately for everyone. And, everyone that has margins lower than us has a big chunk of their route network that loses money. The low-cost and ultra-low-cost carriers in particular lose an awful lot of money. It's a fatally flawed business model.
So some of them are going to go?
I think that they're going to struggle to survive.
Okay, that's about as far as I think I'm going to get you to say that. Just back to the American issue, they pushed the corporate market very hard. Did you benefit from that?
There's probably a small benefit in market share, though we watched the data pretty closely. And while we got a little bit of market share from them, we thought that they were making up close to 100% of their revenue change in terms of distribution expenses. And so I think it's gotten a lot of press, but we certainly thought it was a marginal issue, both for them and for us.
You talk about the supply side. The industry, though, is supply constrained right now. You got an issue with the Pratt & Whitney engines that are going on 320s. You've obviously got the issues with the MAX and the wider Boeing issues right now. Is your sense that we are past the worst of that? There's worse still to come? Kind of just give us a status update.
Yeah, I think we are past the worst. I think we've acknowledged the problems by and large. You talked about two of the big manufacturers that are issues, Pratt and Boeing. I think that we're probably moving up from here. It's not going to be overnight. They're not going to get back to 100%, quickly. But that's okay. Particularly when I talk to Boeing, I'm not worried about the next 12 to 18 months. I want to get structural, and they want to also, and then get them back to delivering high quality, delivering on time, delivering on schedule, and that's the path that's most important.
Tim Clark told me he thought that would be 5 years at Boeing.
Yeah.
Do you think that's a realistic number?
I think it'll be faster than 5 years, but it depends on them really making the kinds of cultural changes that they need to make. But if they make the cultural changes, I think Boeing gets fixed or gets their mojo back quicker. If they don't make cultural changes, they're not going to get their mojo back.
What, if you were to give advice to the chair on what kind of a person needs to sit in that seat as CEO, what kind of advice would you give?
So, what I hope they do is somebody that focuses on the culture at Boeing and letting the 140,000, Boeing has 140,000 great people, engineers, mechanics, let them go build, design great products, build great technology, and focus on that and not focus on the short-term financials. I think that's the biggest issue. Is focus on the upfront, build great airplanes, great products, and the financials will take care of themselves. Don't try to manage the back end, manage it up front.
Start from there. Stay with the FAA. You've been under review by the FAA. Any indication kind of how long that process is going to last? Where are we?
Yeah, everything in that process has gone well so far. No major findings. I think the FAA would tell you. I know the FAA would tell you the same thing if they answered the question. We feel good. We think we've taken this as an opportunity. Really, we had a great safety foundation, but we did have a number of events that happened. But take that as an opportunity to make not just safety number one, but top of mind awareness all the time. And for the rest of my career, for example, every time I talk to employees, I'm going to talk about keeping safety top of mind. We've all believe it's number one in aviation, but keeping it top of mind when everything is going great, still focus on that, all the little things, because all the little things matter.
What do you want to see from the next administration? What do you want to see from the next incumbent at the White House? What helps this industry? What helps America?
Well, it's more about help America and help the world. I think the United States is I think it's the greatest country in the history of the planet. But what makes us great is positivity, optimism, vision for the future. And I want us to get back to being positive, being optimistic, looking to the future, and how do we make things better, and focusing on that. And I think we need that in the United States. I think people would respond positively to that. The world needs it. And we can make the country and the world a better place.
You are by far and away the most international of the U.S. major carriers. Do you think a Trump administration makes your job harder being an international carrier? Do you think we're going to see more fragmentation? I guess is the question that I'm really asking.
I don't think it really affects demand or our ability to fly around the world in any measurable way, one way or another.
It's great to see you. Thanks for stopping by to see us.
Thank you.
Scott, thank you very much indeed. Scott Kirby, John, the CEO of United here at the IATA AGM in Dubai. John, thank you.
Thank you, mate. Fantastic work over the last week. Appreciate it, not just with Scott Kirby, but also Ed Bastian of Delta over the last couple of days. Lisa, let's put those interviews together. The line that we heard from Scott Kirby of United just then, from Ed Bastian of Delta at the end of last week, we're not American Airlines.
Yes.
Seems to be the phrase on repeat in many ways.
And although Scott Kirby also saying it's unclear how terrible it was, he thinks maybe people were overreacting. Them basically saying there is stability. Maybe we're past the sort of peak acceleration in travel, the sort of recovery, revenge travel of the post-pandemic era. But stability and higher income flyers are flying, period, full stop. And so there still is that stability in profits that they're seeing.
A guy has given us a flavour of this over the last couple of days, how difficult it will be to get US executives to talk about the election and how things might change in the next 12 months. You noticed that?
Oh, I mean, that's pretty much every industry. We're focused on our consumer. We don't think it's going to be something else. We expect them to do the right thing for our country. I mean, what else are they going to say? They're the ultimate diplomats because they have to work with whatever administration they're going to be dealt with.
We'll continue trying to execute and keep on executing. In the next hour of Bloomberg Surveillance, this is the lineup for you. We'll catch up with Cameron Dawson of NewEdge about that rotation. Is it going to happen as small caps outperformed this morning? We'll talk to Alex Webb of Bloomberg, our very own, over in London on the latest in NVIDIA, with that stock up by close to 2-3% throughout most of this morning. And the Marriott president and CEO, Tony Capuano, is going to join us as well. The outlook on travel there, with maybe a little bit more on China too, about how things might look in 2025 and beyond.
I'm sure that he'll weigh in on the administration and know what that means for his expansion.
He's got tons to say,
I'm
no
sure.
doubt, detailed.
I mean, look, I think that there is a really interesting aspect here. How exceptional is the United States when it comes to travel? How much are U.S. citizens going international because of the strong dollar? We've seen that pretty much with airfares. And then the other thing is, are you going to see much more expansion in the luxury asset classes just because that is where people have the capital to spend at the expense potentially of the lower end?
I think we have to tease out the politics a little bit more than that. Look, China for a long time has chosen what they would and wouldn't allow to happen in their economy. It's up to them. They've allowed certain industries in, they've kept others out. Thinking of tech. The United States is starting to do the same thing over the last few years. They're basically saying to BYD and some of the Chinese manufacturers, you're not allowed in. What we're going to see happen, I think, potentially, is maybe a response from China. Why wouldn't we see a response from China over the next 12 months? So if you're building up a presence in China right now and you're a US business, how much risk are you taking?
And that's something that's going to be on his mind because I believe they are expanding right now pretty significantly in China.
All of that and more in the next hour. Equity futures right now on the S&P positive by 0.2% as we kick off the month of June. What a June we've got coming up for you.
So much growth is priced into earnings expectations, and there's so much optimism priced into markets.
I think we're priced to perfection on a lot of areas. We're very susceptible to a fast pullback again.
There is sticker shock in prices, and you are seeing the stress in businesses.
The market really has been selling off quite a bit, with technology being the only group that's still in positive territory.
We're still in a bull market, but it's going to be slowing down from here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. We've been through this lineup a few times. You know how it concludes on Friday with Payrolls Friday. The payrolls report at 8:30 Eastern Friday morning. The estimate in our survey at the moment, 190,000. Here's the number for you. Citi's Andrew Honhorst says it's the hiring slowdown, and he's looking for 140K on Friday. Lisa, you've asked the question all morning. If we get a downside surprise, how does this market respond?
Basically, what we've heard is the bond market, pretty clearly, at least in the front end, is going to rally. What we see in risk assets, though, to me, is less clear. And Andrew Hohenhorst, just to build on that, expects this to be a real weakness, the beginning of weakness that does percolate negatively into the perception of the U.S. economy and risk assets. We shall see. Last week was an interesting test where we did see weakness not translate to a rip-roaring rally the way it has in stocks, the same way that it had been in bonds.
Guy Johnson just sat down with Scott Kirby of United Airlines and tried to tease out a consumer slowing down. And what did he say? I feel like I've been talking about this for the last 2 years, the recession that sort of never happened. We're having exactly the same conversation ahead of a number with an estimate of 190, and unemployment south of 4%. And here we are still talking about the same thing, about the prospect of labour market weakening being just around the corner.
Well, because this is coming at a time where a lot of people are discounting the idea of a recession ever coming. So what would the biggest surprise be? That it finally arrives, right? Because everybody has basically said, all right, we're sick of being wrong for the past 2 years and saying there's going to be a recession, and everyone's saying, you've gotten it wrong repeatedly. So how much have we priced it out? I think that might be the question to be asking. How much have we discounted any chance of the labor market slowing at a time where people are talking about no rate cuts and ongoing strength in an equity market that is only taking a pause for a couple of weeks in the middle of summer?
This is why it feels a little bit different this time. Earnings season, and it was the retailers, a loss of pricing power, trading down. What we heard from Walmart, heard this a few times, what we heard from Target, what we saw from certain retailers really struggling in this environment, but what many call just a more discerning consumer. I think it's the caution that came out of retail this earnings season, which maybe sort of ramps up the risk around that story just a little bit more.
Just to build on that, Best Buy's CEO came out with this. Consumers are making tough choices with their budgets. We heard also from Walmart, they're being really discerning with their purchases. All of this coming out at a time where it's clear there is pain being felt. It just isn't uniform enough to show up as true weakness in the overall numbers.
And the moment you get a glimpse of it, at the individual stock level, you get absolutely punished. American Airlines, great example of that. Just a glimpse of weakness. It was poor execution based on what we've heard so far. Stock gets hammered and you start asking bigger questions. Is it them or is it the whole industry? And what we've heard, at least so far, is it's not the whole industry. United said it's not. Delta said it's not.
At this point, it's also who can capitalize on the wealthier customers. And that, I think, is sort of the key bifurcation. At the same time, we're going to be hearing from Marriott's CEO, and I want to hear just how much people are continuing to travel on his end as well. Then we can sort of solidify the nail in the coffin for American Airlines being their problem, not everybody else's. Maybe. Those are not my words. Yes, they are.
The airline CEOs have been sort of banging in the nails over the last couple of days.
Yeah,
Speaking of Guy Johnson.
Yeah, I know.
If you want some scores right now, here they are on the S&P 500, positive by 0.2%. In the bond market, yields lower by 3 basis points, 4.4670. It's not just a ton of data to look forward to. Also, the ECB on Thursday, widely expected to cut interest rates on Thursday. The euro slightly weaker today at 108.42, but coming off its best month on euro dollar of the year so far. Euro dollar advancing in May by 1.6%. 7%. Coming up this hour, we'll catch up with Cameron Dawson of NewEdge Wealth as the first trading day of June kicks off. Bloomberg's Alex Webb as NVIDIA unveils its next-generation AI platform. And Marriott International CEO Tony Capuano as the summer travel season begins. We begin with the big issue, kicking off June following the best month for stocks since February. Cameron Dawson of NewEdge Wealth remaining cautious, saying this: we see large cap equities experiencing volatility in the short term. Given fading momentum and breadth, there is plenty of room for investors to be disappointed or caught flat-footed in the short run. Cameron, I'm pleased to say, joins us now for more. Cameron, good morning to you.
Good morning.
It's good to see you. What are you advocating for this morning for this quarter?
Patience. I think patience in the very near term, just because you've had that deterioration in breadth, deterioration in momentum. It's not fatal. It's not to say that markets can't continue to rise. We know that liquidity and trend are still very positive things, but there has been this fraying under the surface, enough to say expect a little volatility. As long as growth estimates hold in, which I think is the most important part, then that volatility is buyable, meaning any kind of correction, short, shallow, and buyable.
You say patience. There has been impatience for a rotation that's never come about. Now you've been quite in Green Day over the weekend, or at least the team has. What was it, When I Come Around?
Yeah.
Is it coming around?
No.
Or will it be a boulevard of broken dreams?
Oh, I think probably it seems like more of the, yeah, very nice. I feel like an American idiot. So the challenge with small caps is that they are so unloved and so under-owned is that you could see a very sharp rally over the short period of time that can be ephemeral. Look at the November and December rallies. They were very short, but very powerful. But if you look over the medium to longer term, you still have really weak fundamental conditions within small caps. So you have 40% of debt in small caps is floating rate. They hate higher for longer. They have 50% more debt than large caps. So we know that higher rates are weighing on these small caps. But appreciate that small caps are trading at a new relative low versus the market. So don't be surprised if you have one of those face-ripping kind of counter-trend rallies.
So wake me up when September ends. I mean, this is basically what we're looking at a time when we can't really game out when the Fed's going to start cutting rates and what the implications going to be for risk assets. Are you saying that if there is weakness and the Fed does cut rates, that is a buyable dip, particularly in small caps?
It depends what you are doing with growth forecasts. We wonder if gone are the days of the world where we are having a Fed that's cutting rates simply because inflation is moderating. If the Fed moves to cut rates or we start pricing them in, is it because of a bad reason? Is it because growth is coming in weaker? Appreciate that economic surprises have plunged over the last month. Look at real personal spending last week coming in much weaker than expected. We're watching PMIs really closely. We were hoping to see some reacceleration in PMIs. That did not happen in April. So if we continue to see this weakening of data, what it calls into question is consensus forecasts that have moved up materially. They're up 200 basis points for 2024 GDP over the last year. That means that nobody's pricing in a recession, which means we have to ask the question, what could surprise us?
So just to plug ISM Manufacturing coming out today at 10 a.m. I am watching that closely, as are you, as is John. Let's put some numbers on this. If Andrew Hollenhorst over at Citigroup is correct, and we get 140,000 for the headline numbers on payrolls on Friday, will there be a sell-off in the equity market in tandem with a rally in bonds?
I think potentially. We still think that bad news is bad news, simply because you have to have the context of the starting point of estimates. If estimates were expecting a recession, you could get bad news and it still wouldn't be that bad because you're already pricing in weaker growth. You're not pricing in any weak growth in this economy or in the market. GDP estimates, again, are at 2.4%, but consider EPS estimates for 2024. They're set to be up 13% next year to $277 a share. If you start asking the question if that's too high, that's when bad news would become bad news.
How relevant is the election this year to your call?
I think that the election is relevant in the context of yields mostly because of treasuries and the fact that neither party is talking about austerity, neither party is talking about balanced budgets, which means that all this concern about treasury auctions likely continues, given the fact that you aren't going to see any movement to pull back on deficit spending.
So fiscal policy is a basket case regardless of who wins in November?
We're still doing the Green Day thing.
Is that what we're doing? Yeah, sure.
I think yes, because you're not seeing any sign that you're going to move to more fiscal balance, which just means that we should get used to more deficits, more high treasury auctions, and the fact that yields could be pressured higher on the long end of the curve.
At what point does it become punitive for stocks? Because we've been able to live with it for a while.
It becomes punitive if you start questioning the growth story. You can forgive a lot of things if growth is remaining resilient. You can shake off a tighter Fed, you can shake off higher interest rates, but if you start cutting growth estimates, which really relies on the consumer at 70% of GDP, that's when you have the punitive action.
You said you advise patience. How receptive are people to that recommendation, considering the fact that that doesn't really work for the DNA of most people on Wall Street?
Yeah, I think that there still is FOMO. I mean, look at GameStop this morning, and you've certainly seen a big appetite to rush into risk. I think when we think about patience, you have to consider positioning and sentiment. Sentiment is in the 90th percentile, meaning that bullishness is broad-based, as well as the fact that when you look at positioning, you can see that AAII positioning is only about 150 basis points off its 2022 highs. People are positioned for strong equity markets. So what we look at with clients is we say, if you've enjoyed this rally, you need liquidity, some kind of patience before adding back into the market is definitely warranted.
You mentioned GameStop. Can we just finish on that? The stock is up in the pre-market by 75%. Speaking of relevancy, how relevant is this? I always hear a lot of people, every time we get a move like this, they try and say, this means this. This is a signal for whatever their bias was yesterday coming into this move. What does it mean to you, if anything?
It probably means nothing, but if we can try to gain anything from it, it would be a measure of sentiment and risk appetite, as well as liquidity, meaning that if you batch all of the meme kind of speculative things together, that is a reflection of risk appetite in the market. The thing, of course, that's missing, though, is that some of your riskiest parts of the market, small caps, have been completely sitting out of this rally. So there's a lot of conflicting data points.
Cameron, this was great. Cameron Dawson of NewEdge Wealth. I thought my Green Day quotes were subtle.
I thought that was great.
I thought they were subtle.
Wake me up when September ends.
Yeah, that was a good one too.
That was yours,
Yeah,
I know,
that was
I'm
good.
just reliving my glory. My one moment.
Who's Jesus of Suburbia? Who is that? Roaring
That's you.
Kitty? That's me. Okay, all right. Let's get an update on stories elsewhere. We'll leave that there. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Online fashion retailer Shein is set to file for an IPO in London as soon as this week. The offering could value the company at about $64 billion, that according to a person familiar. Shein's IPO could become one of the UK's biggest ever. We reported back in February that Shein was actively looking at London after it decided that it would be unlikely that the SEC would approve it to have an IPO in New York. Former President Donald Trump joined TikTok over the weekend. It was a bid to court younger voters. He made his debut along with a short clip with Dana White of the UFC. Now both Trump and President Biden are active on the app that they have both publicly called to ban. Trump joined the platform fresh off of his conviction on 34 felony accounts in Manhattan. Trump touted that he raised over $500 million in the day following the verdict. And shares of Nvidia and AMD both gaining in the pre-market at least about 2%. Both companies showcased a new generation of chips that aim to power the global boom in AI. At a conference in Taiwan, Nvidia's Jensen Huang announced a new Blackwell Ultra chip for 2025. Its rival AMD also outlined plans to speed up its introduction of new AI processors. Huang said that companies who don't embrace AI will be left behind, and their tech can help firms cut back costs, saying, the more you buy, the more you save. This is CEO's math, which is not accurate, but it is correct. That's your Bloomberg Brief. John.
Love that quote. I'm going to use that. Danny, thank you. More from Danny in about 30 minutes' time. Nvidia is higher by 3% in the pre-market. Up next, we'll get you some morning calls. Plus, Bloomberg's Alex Webb on Nvidia's latest AI announcement. That conversation just around the corner from New York. This is Bloomberg. Live from New York, opening bell 1 hour, 15 minutes away to kick off a brand new trading month and a new week. Equity futures on the S&P 500 positive by 0.25%. Yields lower by 2 or 3 basis points. The 10-year 4.46. 89. Time now for some morning calls. First up, Morgan Stanley lowering its price target on American Airlines to 18. The analyst noting a second quarter guidance cut, but believes there's still an attractive risk reward. That stock is higher by 0.8% in the pre-market. Your second call from Citi, double upgrade for Best Buy to buy, raising the price target to 100. The analyst highlighting positive catalysts, including AI innovation. We're up by 2.3% in the pre-market. And finally, Bank of America hiking its price target on Nvidia to a street high 1,500. The analyst citing AI tailwinds and an overall bullish outlook on chip stocks. The hike coming as Nvidia announces longer-term initiatives, including another so-called super chip. Another one. The stock is up by 3% in the pre-market. Alex Webb joins us now from London for more. Alex, let's talk about this new announcement. What's on the table now for the future?
So it just feels like only yesterday that they announced the most recent chip, which is known as Blackwell. Well, they've now announced that coming in 2025, there will be Blackwell Ultra. And in the year after that, there'll be a new platform that it's calling Rubin, named, of course, for Vera Rubin, who interestingly found the early evidence for dark matter. So I wonder if there's some sort of metaphor in there. But it's all about, of course, accelerating what they're doing right now, while others are racing to catch up. Nvidia is going to keep moving forward, and that's what, of course, has got lots of investors very excited.
Alex, the money's real. Lisa alluded to this a little bit earlier. We've seen big spend coming out of big tech companies, the likes of Meta, Microsoft, Alphabet. You pick them, you name them. They've been buying some of these chips. Alex, how long is this runway? That's the ultimate question. How much more spending can we anticipate from some of these big players?
Well, if you look at the multiples at which Nvidia is trading, the investors certainly seem to think it's got a long way to go. What's going to be super interesting in the next 12 months is we're going to start seeing the consumer products in particular that are leaning on this tech. And we did see a little bit of this announced over the past few days and past week or so, some laptops with AI capabilities built into them. But interestingly, what they do is decide what to do at the edge on the device itself and what to hand off into the cloud. And how much the demand picks up for cloud services, of course, the lion's share of that is going to be from the enterprise, will presumably then determine how much more spending the likes of Google, Amazon, with the web services and Microsoft, particularly with Azure, are going to keep doing in order to support that demand. So next 12 months will be very, very important as we try to ascertain quite how much people are adopting this stuff.
Well, to build on what John was asking, basically, why aren't we asking, could NVIDIA shares double again in the next year? I mean, that was the question people should have been asking at the end of last year. What's the limit here? Just to ask in another way, the same question at a time when it doesn't seem like there's a competitor.
Well, we saw some announcements from AMD, which is sort of the closest thing right now that NVIDIA has to a competitor, but kind of to your point, NVIDIA grew its sales of essentially AI chips in the past year by about $100 billion. AMD is expecting to do $4 billion in the sort of comparable category. So it's got a long, long way to catch up. The kind of hurdle here is most likely to be, it seems at this stage anyway, supply rather than demand. There are only so many devices made by ASML. They make the equipment that lets you in turn manufacture the chips. They can only produce so many of those a year. In turn, that means that the likes of TSMC can only produce so many chips for NVIDIA. We're seeing a couple of others, not least Intel, try to expand its third-party manufacturing capabilities, its foundry business, as it's known. That might help in the medium term, but it's really supply that seems to be the biggest constraint right now.
Alex, to this point, I mean, I was looking at the profit margins. There's something insane for NVIDIA. There's something like 76%, which is unheard of for most businesses. When do people start pushing back if they are just most concerned about getting a hold of the chips? Do you see any pushback from some of the big tech players that are trying to develop their own offerings?
Well, interestingly, we did see what looked like it might be a little bit of pushback. I think it was about a month ago when it was reported that Amazon was cutting back spending on some of these chips. But then it transpired this wasn't necessarily to do with seeking more pricing power. It was actually because they want to get the next generation. And so as long as NVIDIA keeps innovating and continues to be sort of the only show in town, it's very hard to see how others will manage to compete effectively. That is, of course, why we're also seeing many of these same companies try to invest and try to develop their own competing products. It perhaps gives them a little bit more leverage when they are coming to that negotiating table. Apple, of course, is the past master at this. Presumably, some of the others will be trying to take a leap out of Apple's book and be able to play NVIDIA off against their own internal efforts in order to secure better pricing. But again, who is likely to be manufacturing those chips. If they do manage to bring them to market, it's still going to be TSMC. And so there's going to be some constraints on the supply there. NVIDIA has presumably a lot of that supply locked in for the next few years. So they really are in a very powerful position.
One of the best functions on the Bloomberg terminal, ANR. Just a snapshot, brief snapshot of analyst recommendations. And you can play around with the screen a little bit. You can take things back to where we were at the start of the year. So let's do that. We've done it just now. The start of the year, the stock is in the 490s. That's where we opened 2024. Here's the consensus 12-month price target for this stock. 654. That was only at the start of January. And we've just had a street high estimate from Bank of America of 1,500. Alex Webb. Now, the reason, obviously, that I'm talking about this is that, yes, this company keeps performing and outperforming and over-delivering. But the consensus now is 1195. And Alex, the question we've got to ask is why the sell side has really struggled to keep up with this, why this has moved so much more quickly than some Wall Street analysts who were employed to really focus on stuff like this and know much better than I would about where this is going. Alex, what are we missing? Why is this moving so much faster than everybody believed, even the most bullish analysts out there on the street?
I think fundamentally because it was incredibly difficult to predict the level of demand and whether NVIDIA will be able to meet it. It seems as though this train continues to run at a great pace. The fact that this is, the next big thing finally that the tech industry has been looking for. There was a period, of course, when they thought, some parts of it thought that the blockchain was the next big thing. This is a huge, huge innovation, artificial intelligence, and something that is very tangible. We can see the applications across the board. And I think as companies notice that their rivals that perhaps do have AI capabilities, I mean, across all sorts of different industries, companies that do have AI capabilities are being rewarded by the stock market. That also means that they then have to go and try to find these capabilities of their own. That benefits, of course, AWS, Google, Microsoft, the cloud computing companies that we talked about earlier, and then in turn that benefits NVIDIA. So it's almost like a self-fulfilling prophecy that as NVIDIA, an AI, a company that's benefiting from AI, continues to do so, others want a piece of that same tailwind, and that continues to boost the company that is making the picks for this particular gold rush.
Alex, it strikes me as we start talking about the potential valuations of this company, from a policy perspective, federally, is NVIDIA celebrated, or does it start to become increasingly questioned as a monopoly in a burgeoning and important industry?
I mean, when there are issues to do with monopolies, that is often to do with whether they have carried things out that, or enacted policies in terms of the way they behave with their customers that are unfair. I'm yet to see any evidence that that has been the case with NVIDIA. Now, is there a risk that economically, if one company sort of is the gatekeeper for a lot of this key technology? Quite possibly. But as long as they continue to have enough supply, we will, over time, gradually start to see others come into the space. It's a lot, there's a hell of a head start that they have right now. The technology is gradually going to get there, though. It doesn't look as though the sort of system or systemic monopoly really exists, apart from this, kind of lock on the TSMC production capabilities. But there's nothing in there which says they're doing so in an unfair manner. So it's hard to see how lawmakers can really have much complaint.
Alex, thank you, sir, for the update. Alex Webb there with the stock up by 3%. Certainly not throwing shade at the Southside community. This has been really difficult to do. The reason I frame it that way is because we just had 1,500. It would be too easy to sit here and throw shade at the 1,500. I think you've got to remember how quickly this has moved since the start of the year, that we've been playing catch-up. And in some ways, that 1,500 is like catch-up to where we've been over the last month or so.
It also shows how difficult it is to quantify what the AI boom is going to look like and exactly how quickly it will benefit a whole host of players. And that's been, I think, the anxiety that's coming to play underpinning a number of different names. We just don't know. So people are all trying to game out, where they should go in terms of, the coolers for these potential processors, et cetera. How do you get an edge in a fast-moving train that a lot of people say will transform the world?
Sort of stretching for second derivative trades. I just still remember that interview with Jack Caffrey of JP Morgan and what's happened with the utilities over the last month. By the way, just got another estimate for you. This from Goldman. They're expecting a below consensus 160 for the payrolls report that comes this Friday. Consensus about 190. They're at 160. Citi's at 140. More on that a little bit later. Up next on the programme, we'll catch up with the Marriott International President and CEO, Tony Capuano, as summer travel kicks off their plans for the next few months, their plans worldwide for the next few years. That's next from New York. This is Bloomberg. 60 minutes away from the opening bell as we kick off a brand new month, the month of June. Equity futures look a little something like this. Equity futures on the S&P positive by 0.25%, up by 0.6% on the Nasdaq. On the Russell, there's your outperformance, up by 1 full percentage point. Looking ahead to payrolls Friday. Here are the scores in the bond market. The 2-year, 10-year, 30-year, after double-digit basis point declines across the curve, 2-year out to 10-year. Through the month of May, this is what we look like this morning. We're down by a single basis point, 485.80 on a US 2-year. On a 10-year, down 3 basis points at 446.70. The 30-year, just to throw that into the mix. Yields lower there too, 461.52. Quick sneak peek of where we are on the euro. Euro dollar shaping up as follows at 108.47, totally unchanged. Though, Lisa, really decent month in the month of May for the single currency, going into what we're expected to be that first interest rate cut this Thursday.
Yeah, the best month going back to late last year, and this comes as people are expecting there to be definitely a rate cut this week on Thursday, except for that one person who we really want to interview because it seems like an out of consensus call given the fact that the ECB is saying we're going to cut rates. The question is what comes after that, especially given the fact that you've gotten hotter than expected inflation read. What I find interesting is if they do cut rates, how much do you see people increasing some of their expectations for growth? We saw Deutsche Bank do that, but we have seen sort of better than expected economic data coming out of the region, and I wonder how much travel is going to really weigh in on that.
Are you going to have some input on that, yeah?
I'm going to do some deep research.
I think we're all going to do some deep research with the euro at 108. And let's hope it stays there. That's just a personal thing, not a bias on how you should trade, OK? Under surveillance this morning. Another busy week of data on deck. The labour market in focus with jolts coming on Tuesday, ADP on Wednesday, another round of claims on Thursday, all ahead of the main event on Friday, the May payrolls report. Ahead of next week's Fed meeting, we'll also get an ECB rate decision. Bloomberg's Mike McKee joins us now for a preview of some of those data points. Mike, so 190 is the median estimate in our survey for Friday, but some below consensus calls coming through from some big banks. Citi's at 140. I've got Goldman just dropping into my inbox here, Mike, at 160. What are you and the team really focused on going into Friday?
Well, there's two things. And of course, the jobs report is the big dog of all the numbers this week. We saw a weak spending number in the PCE report on Friday, and we've seen weak retail sales numbers. We're waiting to see now if that presages a slowdown in the overall economy, a significant slowdown, and the number of jobs created and or unemployment would give people a clue. The problem is those are lagging indicators, so it may or may not come through, but that's what Wall Street's going to be watching. The Fed's going to be looking at average hourly earnings, no change expected there, but the point is that if average hourly earnings are starting to fall, then labor markets might be a little bit looser. And that is what the Fed is looking for as far as reduced inflation pressure.
I heard Danny Amanis earlier this morning refer to second-tier data. We're focused on the second-tier data as well, Mike. I'm not sure if ISM is second-tier data. I would put it as top-tier data, but whatever. Mike, when you look at the ISMs, given what we saw in the S&P Global PMIs, do you think there's some extra emphasis on those data points, both for manufacturing and services through the week?
Well, sure. It's the same question. Is the economy slowing down? Now, the ISM for manufacturing today at 10, still expected to be below 50, a suggestion that the economy is, or at least the manufacturing economy, is not growing. We get a pushback from the ISM people who say that basically we bottomed out, and if you look at the trend, it's going up. We'll see if that continues. And the service industry, obviously, the big question for the Fed and therefore for the markets, is it slowing its growth? And does that mean that inflation in services come down? So those prices paid indexes in both of those numbers are going to be perhaps the thing that people are looking at the most.
I'm also really excited, Mike, for JOLTS. I know that if you want to talk about second-tier data, that probably qualifies, especially because most people will say, well, it's sort of fuzzy in terms of how accurate it can be. Why are some people looking at this as potentially even the most important report, given the fact that it tends to be a forward-looking indicator on sentiment among businesses?
Well, our company's starting to no longer need a lot of workers. The number of job openings has continuously fallen since the beginning of the year, and that should be good news, but it's still running above the pre-pandemic trend. So as long as there are a lot of job openings out there, the theory is it could push wages up, and that could create inflationary pressures. So the more it comes down towards trend, which is around 6 to 7 million, then people are going to feel a lot better about the economy.
Mike, just before you run, next Wednesday, we get some forecasts too, right? How could they change on this week's data?
They're not going to change. The Fed is locked into no change at this point. What we're looking at is a longer term change, maybe not even for July, but does it pull forward something into September or push back something out of this year entirely? That's going to be the data question that hopefully this week will answer.
Mike, thank you, sir. Mike McKee of Bloomberg teeing us up for the week ahead. It's a massive week ahead. This morning, another big morning for Nvidia. The stock is higher, continuing its string of AI breakthroughs. CEO Jensen Huang announcing a Blackwell Ultra chip for 2025, plus a next-generation AI platform called Rubin, set to roll out in 26. Huang saying the chip giant sees the rise of generative AI as, quote, a new industrial revolution. Can this guy say anything that sends this stock lower?
All I can say is that when I see the picture of him running out in his leather jacket, you just
think of Dan Ives.
I think of Dan Ives, 100%, the rock star of the future revolution, et cetera. I mean, that seems to be what the market is saying. I think you're asking the right question. Are we even underestimating what they're going to do in terms of profitability, given that they do seem like the only game in town, and it seems like their profit margins just are shocking and continue to be so?
The stock was up by close to 30% in the month of May. Just keep adding weight to that very weighty name on the S&P 500. 1,500, the price target now over at Bank of America, which is a street high. That number coming through a little bit earlier this morning. Let's turn to this. Global Airlines on track to turn a $30 billion profit this year. The International Air Transport Association expecting North American Airlines to lead the way, pulling in just under $15 billion. The boost coming thanks to higher ticket prices and consumer demand. However, while profit is rising, so are expenses, as continued delays for new aircraft from Boeing and Airbus limit capacity. The United Airlines CEO, Scott Kirby, weighing in on the consumer early this morning.
Demand for us is steady as she goes. In a way, kind of boring. We spent the last 2 years talking about the risk of recession, and the consumer just keeps plowing ahead and keeps going. And so I think that's likely going to continue. The bigger thing, the more likely change for aviation, I think, is on the supply side. We're at a peak where the number of seats is growing a whole lot faster than the demand in the United States. But as we move into the third and fourth quarter, those numbers are scheduled to come back down.
For better insight into the summer travel season, I'm pleased to say that with us around the table in New York is the Marriott International President and CEO, Tony Capuano. Tony, good morning to you.
Good morning. Thanks
We've
for
heard
having me
from the
back.
airlines, very mixed reviews, and you're welcome back anytime. American having some problems executing, United and Delta say things are okay. In the hotel business, summer travel, just walk us through things and how they look regionally at the moment.
Well, it's interesting listening to the airline CEOs because where they're consistent is about the strength of demand. And we see the same thing in our business. When we looked at Q1 results across geographies and across segments, we saw strong and steady growth. Now, here in the U.S., our biggest market, we are seeing demand start to normalize a little bit. We had global RevPAR of about 4.2%. It was only about 1.5% here in the U.S., 11% internationally, and 16% in Asia. Now, they're still benefiting from some favorable comparisons, but we are seeing more rapid growth internationally today.
See the same thing in the airline business, that if you have this international exposure, you seem to be doing better right now. What is that about? Is that the affluent consumer traveling more? What is that? What explains that?
Well, I think it's a few things. I think the strength of the dollar is driving lots of outbound U.S. travel. In fact, we were looking at the numbers for this summer in Western Europe, and this is off the back of a record 2023. Our forward booking revenue is up about 7%. Going into destinations like France, Italy, Spain, Greece. And I think the same is true for Asia. There was a study that just came out that said for outbound U.S. travelers, among the most desirable destinations is Tokyo. And I think that you talked a little about exchange rates.
Dollar yen 160 helps.
Exactly. The strength of the dollar is certainly driving that travel pattern.
I want to just sit on the idea of what the characteristics of some of these consumers are. Mm-hmm. Is there a feeling that wealthier consumers are going to keep traveling and keep spending, and the more you can capture them with an international offering, the better you are, versus, say, mid and lower income?
Well, I think for us, we're trying to capture at both ends of that spectrum. So we're lucky enough to have the industry's largest luxury portfolio. We announced a few more conversions just this morning. Resorts like Turtle Bay on Oahu and Pelican Hill out in California. So we continue to see really strong demand and pricing power in the luxury tier. At the same time, at the other end of the spectrum, over the last year, we have, for the first time in our 97-year history, moved into the mid-scale tier. And that is a more value-focused customer. And they are absolutely traveling. They're just looking for a better value proposition.
You talk about international travel. There is this feeling that companies that go international struggle with respect to some of the international relations that have been fraying and some of the battles they're in. Are you finding that that's become an issue?
Well, I think we're a bit insulated from that because of our business model. We've got about 9,000 hotels globally, and almost the entirety of the portfolio is owned by third-party owners and franchisees. And so in most of those markets, our owner base is a local market base, or they're based locally. So you go to China, for instance, where we're operating more than 500 hotels today. Almost the entirety of that portfolio is owned by Chinese ownership. And so that maybe insulates us a bit from some of the friction that you described.
Is that deliberate, or is that just one of the outcomes?
I think it's largely deliberate. The real estate at its core is a local business, and so aligning with partners that have deep connections both in the public and private sector, that understand local business practices, that have existing relationships with lenders in those markets has served us quite well.
You met with the president in the last month, right?
I did.
How did that go?
Great. I was lucky enough to be invited for a second time. I applaud the administration for engaging the business community, and it gave me a short window to describe what the administration can do to support the constituents we serve.
Can you share some of that with us?
Of course. So I started with our associates, our employees, and I talked about, particularly in seasonal destinations, the help we need from the administration to expand the number of temporary work visas to try and fill in some of the gaps in high demand markets. As it relates to our owners and franchisees, I really talked about some of the constriction we see in the debt markets today. Many of the regional banks who have been big lenders into the hospitality sector are kind of sitting on the sidelines waiting to see what Basel III has to offer in mid-25 and what sort of burden that'll put on their balance sheets. And so I know in our pipeline, we've got hundreds of shovel-ready projects, which the administration was keen to hear about because of both temporary construction job creation and permanent operating job creation. But we need some help loosening up the debt markets. And then for guests, we really spent a lot of time talking about visa wait times. And so you've got a market like India. I saw this morning their stock market's going to all-time record highs. That growing middle class has a ravenous appetite for travel. But if you're an Indian national trying to get a visa to come to the U.S., the current wait time is over 400 days.
Let's just dissect some of that. Let's start on the first part, the idea that you're looking for more workers to come to the U.S. to help you out. How much does that change under one administration versus the other after the election?
Yeah, it's a great question. I'm not sure we know, right? We have seen support from the Biden administration in terms of working with Department of Homeland Security to expand some of the temporary worker visas. We'll have to see if there's an administration change, what their posture will be.
Immigration has been actually one thing that a lot of economists who come on the show talk about. This has been the big surprise. It has kept wages down and sort of kept inflation from spiraling while continuing to allow growth to expand. How much have you seen that on a practical level in your own business?
So coming out of the pandemic, obviously, we saw very strong wage growth. Here in the U.S., our biggest market, we're starting to see that more normalize, kind of align a little better with inflation.
But if there wasn't as much immigration, how much more difficult would it be for your business?
It would be challenging.
At this point going forward, how much are you seeing wage inflation continue to keep pace, given the fact that it is challenging, based on what you're saying, to get a number of workers?
Yeah, as I said, it's sort of moderated a bit. We're never fully staffed at the hotel level. In a pre-pandemic world, in any given time in the U.S., we might have had 4,000 or 5,000 open positions. During the pandemic and the early days of the recovery, that swelled to 12,000, 14,000. It's back down to around 4,000 or 5,000. And as a result of feeling as fully staffed as we might be, some of that wage pressure has been moderated.
You mentioned the debt markets. Let's talk about the debt markets.
Sure.
It depends who you are. If you're a big company right now, it is wide open for financing. Issue debt, Wall Street will eat it up. Doesn't matter where you are, apparently, right now. But if you're at the bottom of the stack, to your point, if you're local and you're trying to get financing from a small, medium-sized regional lender and you've got a couple of hotels, whatever your business might be, it's a struggle. How are you going to help them? How do you help them?
So it's, again, it's not corporate debt. It is project-specific construction financing debt. We actually see plentiful debt available for existing assets. But if you're trying to put a shovel in the ground and get a construction mini-perm loan, that is quite challenging. And the irony is, when you talk to many of the lenders and they look across their commercial real estate portfolios, they say our hospitality loans are the best performing sector. But because we've got this uncertainty into mid-25 about what balance sheet requirements we might have, often, unfortunately, they're saying, call us middle of next year.
What I find fascinating is it seems like your business is thriving. You're still seeing a lot of travel. It's not like people aren't traveling, but that it could be even better if rates were lower. Are you basically saying that the economy would just be growing at a much faster clip, that you would see that much more expansion if rates were lower, but that it's not necessarily hampering your business and your ability to grow now?
It's a great question. I think when you look at our owner community, the vast majority of them are long-term investors in the sector. And so they understand they've chosen a real estate sector that is cyclical by its nature. They are less impeded by the current interest rate environment and more impeded by just the sheer availability of new origination for construction debt.
I want to get to these three hotels.
Sure.
The news this morning. Can I just say, the resort at Pelican Hill, there's going to be a whole team over at PIMCO waking up this morning who know that hotel very well over in Newport Beach. How excited are you about these three names this morning you've announced?
Yeah, all three. Early in my career, I ran development in the West, and so I was in Newport Beach when that hotel was developed. As you point out, it is an iconic asset. Donald Bren and the Irvine Company have built a generational asset there. And we are extraordinarily proud that they've selected us and the St. Regis brand for that hotel. It'll be a terrific addition to the portfolio.
How do things change when you do things like this? Incredibly successful resort, very much loved in the area. Do you put a St. Regis brand on it and it changes overnight? What does that look like?
Yeah, I mean, we're still working through some of those specifics. I think the St. Regis brand will maybe be kind of underneath the Pelican Hill Resort name. It is such an iconic name, and there's so much equity in that name. This would be a good question for the folks at Irvine Company, but I think from their perspective, among the things that attracted them to us, the power of our revenue engines, the reach of our global loyalty program, and the strength we're seeing in the group segment, which is an important part of the demand picture there.
Are you going to tell me which luxury hotel in New York?
On Friday.
On Friday.
If you have me back, I'll be happy to.
All right, you give us a call.
All
Tony,
right.
it's good to see you.
Nice to see you.
Thank
Thanks
you.
for
Let's
having
catch
me.
up soon. Tony Capuano there, the Marriott International President and CEO. The stock's doing okay in the pre-market, so you survived. We're up by 0.2%. If you were wondering. Equity futures on the S&P 500 positive as well this morning by a similar amount. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Waste Management, North America's largest waste recycling firm, has agreed to buy medical waste disposal company Stericycle for about $7.2 billion. It's one of the biggest acquisitions in the sector of waste management. It also strengthens the company's position as the largest trash hauler in the U.S. Now, meanwhile, the Houston-based company has bought several other disposal firms over the past few years. Shares of Paramount higher in the pre-market trade, up by nearly 5%. Bloomberg News team has learned that movie producer David Ellison's latest offer for Paramount includes a sweetener. Non-voting shareholders would have the option to cash out a portion of their stock for about $15 a share, which is roughly a 26% premium to Friday's close. But it's only for some of the shares. It is the latest attempt by Ellison to court non-voting shareholders who have feared his bid to heavily favored Sherry Redstone in her controlling class of shares. Qualcomm says laptop users will be able to leave the power bricks behind. It said that new efficient semiconductors will power smaller, thinner laptops.
So people are going to be able to not only have the best performance, not only have the AI use case, now have a very small and thin laptop, but they're going to have battery life for everything they need to do. You're going to leave your charger at home.
Qualcomm's chips will also underpin the new line of Microsoft Copilot Plus PCs. Laptops running on Qualcomm Snapdragon X Elite systems will have as much as twice the battery life of traditional parts. And that's your brief, John.
That's what we want to hear, Danny. Thank you. Better battery life. What am I using? Laptop? PC?
Well,
what am I doing?
You're using, I don't know.
Am I
What are you
upgrading the
using?
desktop? Is that what I'm doing?
Yeah.
We're going to see this big upgrade cycle of PCs.
Well, I mean, I guess if they can cook dinner for you and, manage your children, which is the promise of AI.
I imagine that's not the promise of the latest Dell PC. It might be. If you want to share that with us, but I imagine it's not. Futures positive by 0.2%. Up next, setting you up for the day ahead. You're watching Bloomberg Surveillance. We are hitting the ground running, easing into this morning, and then as this week picks up, things pick up really, really quickly through the month of June. It concludes with a big debate between Biden and Trump at the end of this month. Before we get there, let's deal with this week. This is what things look like. Your trading diary to kick off the week and a brand new month. ISM manufacturing data, 10 a.m. Eastern Time, a little more than an hour away. Tuesday, we'll get jobs plus factory orders and durable goods. Wednesday, ADP jobs data. Thursday, an ECB rate decision plus jobless claims. And Friday is the main event. It's payrolls Friday. In our survey right now, the estimate is 190, and we're all trying to figure out the same thing. It's the thing we've been trying to figure out for the last 2 years. Is that slowdown just around the corner? Is it like just around the corner? So let's talk about what we've heard from the C-suite so far. From the airlines, from Delta, speaking to Guy Johnson. From United, speaking to Guy Johnson, basically saying things are okay. They're not stellar, they're not fantastic, they're not running away, but they're okay. What did we just hear from Marriott? Things are normalising. Not weakening, we're not seeing big deterioration, just normalising.
What I'm trying to think about, and actually as you're talking, I'm just writing some words down. Basically, how do you sugarcoat a slowdown? You call it normalizing. What's the distinction between normalizing and a slowdown? Is normalizing the beginning of a path to a slowdown? Or is this really just sort of the lag effects of the pandemic coming off? What does that look like? We don't have any sense of this. And I think that's the reason what people have gotten so wrong is we don't know what normal we're going to. We talk about, for example, rates. What is a normal rate in this environment? We have no clue. What is a normal pace of demand right now? It depends which cohort you're in. Are people on a permanent vacation from being able to go to the office 5 days a week? I mean, there are all of these questions that make it difficult to know the distinction between normalizing and a true slowdown.
One is relative, the other is absolute. One is relative to where we were just before. So we are weakening, we are not weak. We are cooling, we are not cool. The other is absolute. If you landed from Mars, how would you describe the current situation? Right? If you were sub 4% and printing anywhere between 150 and 200K on payrolls, I don't think you'd describe those conditions as weak. But if I told you where we were, relatively speaking, 6 months ago, north of 2, north of 3, big numbers, you'd say things were cooler, but not cool.
People don't like to say this time is different. And typically, in historical periods where there is some sort of weakening in the labor market, typically you've seen it deteriorate pretty quickly. And the difficulty that people have right now, and this is what Andrew Hollenhorst over at Citigroup has been grappling with, people are trying to say, well, this is a normalization process that can look more like the mid-1990s where you don't see that big drop-off. He's saying it's not going to work like that. And around the margins, you see that weakening. I want to see the downward revisions, what they look like, almost as much as I want to see the headline number. And then if we do get weakening, do people start to rethink what it means between normal and a true slowdown? And that, I think, is going to be an interesting kind of angst that we are seeing under the surface in terms of how stocks are reacting to some of these data points.
We've been wrestling with this for months. What is the difference, the big distinction between a welcome easing of the labour market, a welcome cooling and an unwelcome deterioration. And it won't matter what the number looks like on Friday, we'll still be having that debate. I want to fit in this number from Nvidia. Once again, it's higher in the pre-market. We'll talk about game, no doubt, in the next hour, but Nvidia is just running away with it once again, up by 3.1% going into the cash open. Coming up tomorrow, let's bring you the lineup going into Tuesday. It looks a little something like this. Julian Emmanuel of Evercore, BlackRock's Wei Li, former Federal Reserve, Bank of India Governor Raghuram Rajan, and JP Morgan's Kelsey Barrett. From New York, this is Bloomberg.
Day 8 of the clay court slam at Roland Garros. Coco Gauff blasted her way into the quarterfinals for the 4th straight year with an excellent win over Elisabetta Cocciaretto. The American jumped out to a 5-love lead in the opening set and didn't look back, firing 19 winners in the victory that took exactly an hour on Philippe Chatrier. And don't forget, you can watch all the action from Paris live on Tennis Channel. Our daily coverage starts at 5 a.m. Eastern.